sort of gotcha votes in the Senate before they can take their vote on the budget. When they have voted on the same exact budget, then they can work on the legislation. The deadline set in this budget for the real legislation is February 16th. So essentially we're seeing them work now on the first half budget portion of this. The Senate will then go to what they hope will be no more than a week-long impeachment trial. And after that, there's work on the bill itself where they have to get down to the exact details of what they want to pass.
Jack, I know this is the first test to see whether, the Democrats can actually work with the Republicans under this new administration. But will it be a test of things to come, or is this separate just because of the large amount of money?
Well, if they were looking for low-hanging fruit to work with Republicans, this would be it. Even though there's this divide on how much money to spend and how to approach the coronavirus stimulus, this is not really as partisan as what you may see when we get to round 2 of a reconciliation push by the Biden administration, which, the talk on that is a major green infrastructure, climate-related bill that could be even more difficult. So if this were to fall apart, that could be a sign of bad things to come. If this works, it doesn't necessarily things are going to be easy working with Republicans in the future.
Jack Fitzpatrick, it's like the yelling and screaming late in that movie Lincoln with Daniel Day-Lewis and Sally Fields. How's Kevin McCarthy's week going?
He is in a rough position. He has stood by really both the Republicans in his caucus who are under pressure. Marjorie Taylor Greene, Democrats are going to vote today to remove her from her 2 committees. McCarthy stood by her despite the QAnon conspiracy theories. He also simultaneously seemed to stand by, and the caucus stood by Liz Cheney, who kept her leadership position. So he didn't necessarily make a clear decision on the future of his caucus, but he kept everybody in the loop.
Jack, thanks for the update there. Jack Fitzpatrick with us, our Bloomberg government budget reporter as well. We'll drive forward this conversation. Somehow the politics of the GOP may come up. Mr. Barr, not Michael Barr, Andrew Barr, Republican from Kentucky in the 8 a.m. hour. This is Bloomberg Futures up 7. Stay with us.
一个就是我们看中它的那个品牌吧，它品牌就是说东西比较干净嘛，然后比较方便的话，味道也还可以的话，我觉得我会考虑吧。外卖的话呢，也是一种方式，就是品种会多一点嘛，各有它的特点吧。
这个车的话，目前我们是通过这个手机 APP 就手机扫码，然后微信和这个支付宝扫我们这个车上的这个二维码，大家就可以进入到一个小程序的这个界面，然后呢就可以选购自己喜欢的商品，然后付款之后呢，这个柜门会自动打开。
支付成功，请拉开右侧车门取货并关紧柜门。
然后我们会取餐，然后完了之后呢，就把餐这个柜门关上，然后整个购买的这个流程就会结束。
柜门已打开，请取出货物并关好柜门。
Jim Snabe, thank you so much for joining us. What was the biggest thing you've learned about what a leader needs to be?
Well, it's really an emotional, or it's about being authentic, about believing in the path you're taking.
This is Bloomberg Surveillance, Tom and Francine from London and New York. Now, Royal Dutch Shell added to the disappointment of Big Oil's fourth quarter. The company reported net income that fell short of expectations. Still, Shell reiterated its commitment to growing the dividend again. Well, here's the chief executive, Ben van Beurden, at the European Market Open.
The year was a very tough year, let's be honest, and a very painful year.
How come earnings missed the street's expectations? Why did these analysts, did they get ahead of their skis here, or did you have some last-minute accounting changes that surprised them?
Well, it's probably a combination of a number of factors, I would say, Matt. But listen, you know, at 0.4 billion versus 0.6, the absolute delta is, of course, very small. Percentage-wise, these numbers are magnified because we're talking about low numbers, and it's very, very difficult with a lot of, indeed, adjustments, and we did have a number of deferred tax asset adjustments to get it completely right. I thought the street did a pretty good job to come as close as $150 million on average from where we were in the quarter. Now, if you look at the entire year, though, I think it's probably more sensible to look at that. And again, $34 billion of cash, because that is, after all, the better measure for us to be measured on, is, I think, a credible and a resilient performance. On top of it, Matt, I would say that the countermeasures that we took early in the year, early in 2020, when we said we were going to find $8 to $9 billion of cash to help us in these difficult times, we actually delivered $11.5 billion. So I think we did well in that respect. It didn't help us from taking the painful decision to also reduce our dividend and rebase it. But I think if you look back operationally over the year, I think our staff did remarkably well. I'm very proud of them.
Yeah, let me ask you about how shareholders have received all of the messaging you've given around the dividend and buybacks. You took that historic decision to cut the dividend, the first time in many decades. That was just last year. A couple of quarters later, you raised it modestly, and you also committed to further buybacks. Have investors kept with you along this journey? What's the feedback been from investors?
Well, and as you can imagine, there's a range of reactions. I think nobody, and certainly also not the company, welcomes the need to reset the dividend. But at the same time, it was also a necessary and inevitable thing to do to not only preserve the financial resilience of the company, but also to preserve the long-term future of the company.
Capital expenditure by oil companies, by oil and gas companies, is at historically low levels. Do you think the sector is investing just enough to avoid a supply crunch? Could we see a spike in prices as a result of this phenomenon over the near term?
I think it's a very good question, Anna, and I think it depends a little bit on the time frame at which you look. At the moment, of course, we see pretty good oil prices. I think it's approaching $59 today, Brent. But I think that is probably much more driven by short-term factors. Demand is not back where it was a year ago, but then again, we see a lot of discipline also from OPEC Plus, and therefore the market is being held in balance quite well. If you look at the slightly longer term, yes, we're not the only ones, of course, who has cut back on our capital spending. We went from a plan of $25 billion to spend in our entire business, but not just in oil production, to $18 billion. So that's a $7 billion drop. And as I said, we're not the only ones. So fast forward a little bit, and yes, indeed, I would imagine in the second half of this year, we're beginning to see not only recovery, but we're beginning to see a little bit of tightness in the market appearing. And I believe indeed that next year, when the recovery is probably complete, and in the years thereafter, it could well be that we see a tightness in the market that will provide for more upside pressure on the oil price.
Well, that was the Royal Dutch Shell Chief Executive Ben van Beurden speaking to us a little bit earlier. Now, the market, of course, firmly focused on what treasuries are doing. We have a little bit of data later. And, of course, it's all about the steeper yield curve. So, Tom, focusing on the yield curve, it's a reflation trade. A couple of questions we have, not only on what inflation we're importing from China, but, of course, what happens to China dynamics, giving some of the wobbles that we've seen in activity. I'm also looking at, of course, Italian politics and the UK later on with the Bank of England decision. Up next, Jason Farley, Johns Hopkins nursing professor. We continue tracking COVID-19. We look at the variants and some of the concerns with vaccinations going forward. This is Bloomberg.
Focusing on is not so much what goes inside the cars of the future. So they're not working on doing a self-driving car or an autonomous vehicle themselves, but rather they're focusing on the surroundings. So everything that's going to go on outside the vehicle in the future. So that's sensors, cameras, radars that are embedded into roads, street signs, traffic lights, bus stops, infrastructure that's going to provide information, something to help the vehicle know what's going on around it, to help it, stay on schedule if it's a bus, or avoid other vehicles, avoid accidents, provide information about weather conditions, potential hazards down the road, and so forth.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Tom, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. And Johns Hopkins has been at the forefront of the international response. Every day, we bring insights from experts in public health, infectious disease, and emergency preparedness. Well, we're delighted today to be joined by Jason Farley, Johns Hopkins nursing professor. Thank you so much, Professor Farley, for talking to us today. When you look at some of the things that we're experimenting with globally, there was news that there could be some kind of use of Pfizer vaccine combined with the AstraZeneca, which would help with the global rollout. Is this going to be the narrative going forward, doing everything we can, even combining vaccines, to make sure that we vaccinate quickly?
Yeah, good morning from the U.S. Certainly, the pressure in the EU has prompted the conversations between Pfizer and AstraZeneca to consider combining. We already have some preliminary data, at least from here in the United States, on the combination. When the Pfizer vaccine was approved, for example, many of us who were in the AstraZeneca trial, including myself, were instructed that we could possibly be unblinded because of the lower, at that moment, signal of efficacy. And therefore, we were given the option of being unblinded and receiving the Pfizer vaccine, of which many healthcare workers who were on the front lines of COVID chose to do. Subsequently, we saw great data from Pfizer, and we now know that the efficacy of the vaccine is quite great for severe disease as well as hospitalization. So there probably wasn't a need to receive both. But there is a significant handful, at least in the United States, who've already received both the vaccines as part of the trial. And so I would encourage the companies to look at those individuals closely while they're starting a new trial of about 800 participants in the UK announced soon this week.
We also heard actually yesterday that the way that the UK is giving out the AstraZeneca vaccine, which is one dose ASAP, and then you wait 10 to 12 weeks for the second dose, actually has an 82% efficacy rate, I believe. Are we going to see more countries do it? Could the US be looking at doing the same thing?
So right now, the signal from the Biden administration is that that will not be the case. We've heard repeatedly from Dr. Fauci, the most important thing was increased distribution, being able to get the doses in the sequence as prescribed. Importantly, we're concerned about particularly the variants and the pressure placed on the vaccine when an individual has some level of antibody, but not level of antibody that's protective. And so concerned just about the duration between dose 1 and dose 2, although certainly it will increase supply, that's important. And some vaccine is better than no vaccine at all. There's still the biologic plausibility that, having a little bit of antibody, then it being exposed to.
I'm scheduled for my second dose here, T-minus 10 days and counting. So we're looking forward to that. Tell me about when the age drops. When do we get from the 80s and the 70s to the 60s? And when do we really drop down to a larger audience?
Sure. So I think it's all about how quickly the manufacturing and the distribution supply chain can provide us vaccine. And so right now, for example, I am getting calls from my patients. I'm getting calls from others saying, hey, when am I going to be in line for this vaccine? It's particularly troubling when we hear a lot of data emerging where a lot of people are hesitant to get the vaccine. For example, if you look at long-term care facilities, where only about 30 to 40% of the workers in long-term care facilities across the U.S. have reported receiving the vaccine out of their own choice, not that they weren't offered it, they just were hesitant to do so. So we really need to ensure that people have access. Those who want to raise their hand get access as quickly as possible. And right now, most states across the United States are in group 1C, which would indicate that we're vaccinating those 65 years of age and older. And it did expand in that group to more frontline individuals, frontline healthcare workers and essential workers were included in that group. But many healthy individuals in there, below 65 with maybe, a few comorbidities, not severely ill, are still waiting in line.
Thank you so much. Jason Farley there. Be sure to check out VRUS Go on the Bloomberg for the latest information, and you can tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now let's get straight to the Bloomberg First Word News in New York City. Here's Ritika Gupta. Hi, Ritika.
Hi, Francine. President Biden is drawing a line in the sand on his coronavirus stimulus proposal. He's told House Democrats he will not back off his plan to send $1,400 checks to millions of Americans. The president says he is open to tightening the eligibility for the payments. Republicans have suggested that the checks be smaller and that fewer people get them. This will be Janet Yellen's first public effort to address the turmoil involving GameStop shares and broker-dealer Robinhood. The Treasury Secretary meets today with financial regulators. One of those regulators, the SEC, has already said it's seeking to identify potential misconduct. It also will look at brokerages' decisions to halt buying. And McKinsey & Company has agreed to settle claims stemming from the opioid epidemic. Bloomberg's learned that the consulting firm will pay more than $550 million to end lawsuits by roughly 4 dozen states. The suits claim that McKinsey helped fuel the opioid crisis by providing marketing advice to drug makers. And more than 30% of U.S. property owners are considered equity rich. That means their property is worth twice as much as the underlying mortgage. According to Atom Data Solutions, the count of equity-rich properties rose to 17.8 million of the 59 million mortgaged homes. And on the other hand, underwater homes, those worth less than the mortgage, are now over 10% in 6 states in the South and Midwest. Global News 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom.
Ritika, thank you so much. Coming up, Adam Posen. We'll talk to Dr. Posen of the Peterson Institute about America, the different ways we move and how the central bank may adapt. And then, of course, later in our half hour, Adam Posen on the Bank of England announcement that we'll see at 7 o'clock. Wall Street time. Stay with us with futures up 5. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Strong pickup in economic activity projected for this year should generate a temporary boost to inflation also. But whether this becomes embedded into inflation expectations and produces a more sustained increase in underlying inflation, that's an open question.
It is an open question of the gentleman from Chicago. Right now, let's look at the open question on a chart. And all you need to know is the straight line, and it's moving from the lower left to the lower right. It is inflation expectations as witnessed by the guesstimate of 5 years out, and then inflation 5 years out from there, the stability of pre-2007. Then down we go to significant disinflation. And well, there's a new trend, as Charles Evans pontificates about there moments ago. We get perspective from Adam Posen of the Peterson Institute, of course, one of the nation's wonderful economists. Adam, I could do a 2-hour conversation with you. I'm Davos ready for that. But I've got to ask you about, when the trend is there, the respect we should have for new inflation expectations.
We should have respect, Tom, in the sense that we've rightly ignored them for about 20 plus years. But now it's time to start putting them in the forecast, that you have to take it seriously. And I think that's why Fed Chicago President Evans is talking. But there's a difference between acknowledging there's a risk and either believing it's big or that you need to change policy.
The media approach here, folks, and I'm going to do this right now just to tease Adam, is to hearken back to the 60s. Samuelson of the Washington Post has written about this Walter Heller inflation. OMG, the world's going to die at 5 or 6 or 7% persistent inflation. That's the easy way to go, Adam. What's the real world that we're going to see?
Great question, Tom. I love that you know the classics. The real world question we're going to see is in roughly 12 to 18 months, when you've got a huge amount of stimulus and some pent-up savings coming online, and the unemployment rate starts getting down below 5. Does the U.S. get up to a sustained, meaning 6 months at 3 something in CPI inflation? And how long does the Fed wait before reacting? Chair Powell, Vice Chair Clarida, and others have made clear they're going to wait, which I think is the right call. So the real action is whether or not you get an acceleration of inflation, a de-anchoring of inflation expectations in, say, summer and fall of 2022. That's what we're waiting for.
Adam, how long do you think they'll actually wait to normalize if that happens? And what if at the same time we're importing significant inflation from elsewhere, say China?
Good question, Francine. I have to push back like I always do at the word normalized. The policy has to be judged by whether it's right for the current conditions. There's nothing normal. But in terms of whether they raise rates, I think they are wisely going to wait until they see it showing up in widespread wage inflation or in a sharp spike in the 5-year forward and similar measures. And that will take a while because there's a lot of people on the sidelines not in measured unemployment, and there's a lot of fear. So I don't think you're going to get wage inflation. As we've seen elsewhere, without wage inflation, it's very hard to get chunky inflation numbers. As for China, I think the real international comparison issue is not going to be much from the way of inflation from China. It's going to be if the U.S. does get an inflationary boost and Europe and Japan do not, what happens to the currency?
Adam, does this really all depend on what kind of stimulus package we're getting in the U.S.? Or are they, are inflation expectations kind of de-anchored from some of the conversations that we'd maybe have more in 2019?
I don't think inflation expectations are that de-anchored, Francine, but I do think the stimulus package is really right now is about diminishing human suffering, and mostly it's not about stimulus, it's about funding a better distribution, a faster distribution, a fairer distribution of vaccines, and protecting frontline workers, educators, state and local government. The question is, how much does savings come down rather than stay up in the household sector? And how much structural change is there? Are we going to have mass unemployment continue in the restaurant sector and people having to find new jobs? Or are they going to reopen? I think those are the open questions. I'm inclined to thinking there is going to be more displacement, permanent displacement for some of these sectors. And I'm inclined to think that the amount of savings people are going to keep doing is going to be higher than it was pre-pandemic. But that puts me at the lower end of the spectrum of forecasters in terms of worrying about inflation risks.
Adam Posen with us, and we will continue. I'm really looking forward to speaking to him of the challenges and the originality of United Kingdom economics here before the Bank of England. It is an important announcement. Kenneth Frazier is one of the truly great stories of American business history, starting out with next to nothing in Philadelphia. Ken Frazier with us, and we will continue. The CEO of Merck & Company. He will retire, which is unimaginable. Like Bezos, that's not going to happen. I don't know what Ken Frazier is going to do, but I guess it's some form of executive chairman as Merck manages the changes of the guard. Ken Frazier moving on at Merck, as we saw with Mr. Bezos the other day. Futures up 3 now, futures up 11. The bigs, I really want to emphasize just round trip, 23 up to the angst of fear of 37. Adam Posen was on the phone, says go to cash at 37 as we come back down to Nirvana. A better story across the board, maybe a little bit to do with Washington. So we'll come back. We're going to put it on that. Andrew Simon will join us. I really want to emphasize somewhere in between that. The Bank of England. Stay with us. This is
Gentlemen, it's time to buy euro. I'm placing an order to buy at 119.91 too. So order placed. If you're looking to buy euro, you're into it right now. The price is 119.91.
Transport. All that has led to auto and electronic makers to boost their chip buying. And that is the Bloomberg Business Flash. Francine.
Into it right now.
Thank you so much, Ritika. Now, the Bank of England prepares to release its latest rate decision, along with a report that considers pushing borrowing costs below zero. Well, back with us is Adam Posen, Peterson Institute president, and a long time ago, far away, also involved with FTC at the Bank of England. Adam, thank you so much for staying with us. When you look at actually what's happening in the markets, it's mind-boggling. Thank you so much, Ritika. Now, the Bank of England is incorporating, I guess, the negative rate scenario in its toolbox. The markets are discounting it, so they say, yeah, they're talking it, but they go there. How do you see this dynamic evolving? Adam, thank you so much for staying with us. When you look at actually what's happening,
I think the Bank of England has a genuinely awkward position. They've got very noisy data, but I think they have to focus on the fundamentals. Fundamental one, Brexit is as bad as I and a few other people said. It's not just teething pain. Fundamental number two, by some miracle, vaccine distribution and the late lockdown has been working position well. They've got very noisy. And fundamental number three, but I think they have.
Position opened, long position on euro at 119.91.2, just right here. Okay, hold on, guys.
And that will put a negative pressure on the pound, which they frankly want. And then probably by May they will implement it when it turns out that the
hold on, guys.
Thank God, public health recovery from the virus is overtaken by the Brexit problems persisting.
Adam, every time we speak to the Bank of England Governor, Andrew Bailey, and he has been very generous with his time for Bloomberg TV, you know, there's the debate on when the optimum time of actually implementing negative rates is, right? So what point in the cycle is it a better idea? Is it right when the recovery starts taking place, or then is that too late?
It's not too late, I don't think, but it is dependent on what you think the outlook is more than 2 years out. And it is dependent on what other factors are driving the recovery. If in the UK case, the recovery is just an immediate relief rally on the disease, then that, like the disease itself, God willing, is temporary. And you have to look through that. I think in the end, the UK, remember, despite recent data, it has the highest deaths per capita in the G7, has the slowest recovery in the G7. They're going to have to move, I think.
Adam Posen, you have the advantage of Olivier Blanchard at the Peterson Institute. He and a guy named Summers are known for the chronic long-term effect of unemployment. Are we in the vicinity of true hysteresis coming out of this pandemic?
I think, as Olivier would admit, the evidence since their brilliant paper in the mid-'80s characterizing what really was going on in Europe and what was really going to happen later in the U.S. is become more mixed in the sense that, yes, there is hysteresis, but the scarring doesn't seem as permanent as we once thought. You can see that in the return to high labor force participation rates in not just the U.S., but in Europe following the financial crisis. So it's more like an accelerator than a one-way door. But I think Olivier's point, and again, I shouldn't speak for him, he'd be glad to talk with you, but I think the point to take away from Olivier is similar to what Chair Powell and the Fed is talking about, and now Secretary Yellen is talking about, which is that there is a real cost to letting potential growth persist, and some of those costs are long-lasting, and they're felt by the people at the fringes of the labor market, and so there's a reason to emphasize a hot economy it pulls people back into employment.
Adam, what is the effect of the stimulus misapplied to the people that desperately need it? It's a fact and a fear of conservative America that government spends money, and maybe that's a good idea, but they don't apply it with a vigor, with an acuity to those that really need the funds. Are we going to do that with the next tranche of stimulus?
We're going to do that with a small piece of the next tranche of stimulus, but people should keep this in some amount of perspective, given all the amounts of corporate spending that often doesn't get a high return either. If you look at the package that was passed nearly a year ago in March, April of last year, you look at the package that was passed in December, and you look at the bulk of the Biden administration proposal now, it is going to the people that need it. And in fact, the proposal on the table now, they won't say it this way, but I don't look at most of it as stimulus. It's working the problem. It's funding vaccine rollout. It's making sure state and local governments don't have to contract basic services. It is providing long-term unemployment. It is doing things that are really about the suffering and the dysfunction coming from the pandemic. Then you get into where these stimulus checks, do you need them to everybody? And the answer is, I pick up on another conservative theme, which is one I agree with. You know, you do a lot of means testing, you get very intrusive nanny government that creates a lot of resentment and a lot of distortions and a lot of gaming. So it's better to just say, okay, we're going to cut off the disbursement of checks at this income and not get into people's business and not try to incentivize them in very intrusive ways. I think that's better, and it's less waste in implementation. So then comes the question, should the cutoff be 100,000, 75,000? That's where the debate should be. And that would, at the margin, probably save some money that doesn't need to go out. But it's not a big deal. It's not socialism. It's not some huge misstep.
Adam, thank you. Adam Posen, the Peterson Institute president, joining us on a number of things. The Bank of England and, of course, what's happening with Treasuries. Bank of England actually just minutes away from releasing their rate decision. Tom, if you round up exactly what we're expecting from the Bank of England, no real change in interest rates, no actually real change also in bond buying program. What we are expecting is a possible downgrade of the near-term forecast for the economy. So I know Tom Keene and his gang will be all over this. More Bloomberg surveillance ahead, this time simulcast on radio and TV. This is Bloomberg.
To be an action that was either illegal or caused disruption. This was really political satire, kind of writ large, and it was all about actually trying to get to the man himself and make him see how we see him. And in order to do that, we knew it had to be big and it had to be colourful and it had to be somewhere where everybody could see it. It's important because we didn't just do this for attention. This was actually about making a serious point, which is that the majority of people in this country do reject the politics that Donald Trump represents.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Of excess credit, liquidity and boundless enthusiasm, there will be many bubbles forming in markets.
The system is, from a financial stability perspective, still is robust.
We haven't seen signals that these trades will spark any systemic risk.
The world doesn't shift just because you're buying shares online.
Markets are rewarding places with vaccination and normalization strategies.
There are a lot of people who can't go back to work.
The virus dictated the downturn, and it will dictate the pace and the shape of the recovery.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures unchanged this Thursday morning at about 90 minutes time, initial jobless claims. But Tom Keene, we have to start with a monster milestone that we've hit in the last 24 hours. Worldwide, more people vaccinated than confirmed cases. Real progress.
And there's real progress. And what I love about it, John, I've mentioned this a number of times, in America, it's incremental. It's the day after day of it, even with the snowstorm in the East Coast and the disruption. You see it in the newspapers, all keeping that bar chart of the percent of the public 1 dose and the percent of the public 2 doses. We're way behind on 2 doses. I'm John, like in 8 days or 9 days. My people have that date.
Okay.
But, the first dose, it's building up, as you say, every day.
Relative outperformance in the United States versus Europe. How do you push that through this market? Tom Keene, euro dollar, a break of 120. Yes. We've been talking about it for the last week, the last couple of weeks. There it is on the screen, 119.90. On my terminal, Tom, down about 0.4 of 1%.
I've got the chart by my podium here. I'm not going to show it today. But, John, what I am going to say is we've seen 4 standard deviations on euro, a little misleading, from +2 all the way down to -2 standard deviations. Weak euro is a real path.
I can't wait to see that chart a little bit later, Tom.
We'll try
really
to get
excited about that. Thank you. Lisa, one of the consensus trades of 21, just starting to crack a bit.
The idea of the dollar weakening versus the rest of the currencies, and this does come with the vaccination schedules that you're talking about. Although the UK is doing all right with their vaccination schedule, and we did just get that Bank of England rate decision. At 8 a.m., we're going to be hearing from Governor Andrew Bailey. Really interested to hear what he has to say about the negative rate debate going on in the United Kingdom. John, I know you've been following this. The idea that they are willing to deploy them, the market is pricing them in, and yet the economy will pick up inevitably as those vaccines get in people's arms. 8:30 a.m., this is the big number, in my opinion. U.S. initial jobless claims following another really underrated number yesterday, John, and that was the ISM services data, which came out at the strongest since February, unexpectedly so. The idea, people actually coming into the labor market in greater numbers than people had previously expected, even in services, even amid a worsening pandemic. And also later today, Janet Yellen, Treasury Secretary, meeting with the Fed and SEC heads on recent market volatility, talking GameStop, AMC. The question is, what can they do? Was there any law broken? Was there anything violated? How much are they going to look into manipulation by Reddit users that possibly are bots or not necessarily representing themselves in accurate ways? And it'll be interesting to see what the messaging is, if nothing else, John.
This is great, but, John, I don't know. She was going later in the day, and I didn't really care what Secretary Yellen's doing. John, 3 p.m., Tots, Chelsea.
Oh, there we go.
To see which season is blown up.
Nice. I look forward to that. Do you know what number of the morning is, though? Not related to football. 700,000. They're the fees Secretary Yellen received from Citadel, Tom.
Yeah, I thought I saw a bigger number than that.
Let's not brush this to one side. This is important. Does Secretary Yellen need to step aside and let someone else lead this? I think those questions will be asked repeatedly.
That's a different question. Yeah, I can understand the idea she should recuse herself from this. That's an interesting question. No question about that.
Should we get to the price action of the morning?
Please,
Equity futures unchanged on the session, briefly in negative territory, now positive, slightly up a point on the S&P 500. Euro dollar, there's your break of 120. Euro dollar down to 119.92. We're off by 0.4%. That's a stronger dollar. But if you get to euro sterling now 88 pence. Got to move there in sterling's favour as well, Tom. A lot of vaccine trades starting to come through, I think, in more prominent ways. The UK is ahead of Europe. The United States is ahead of Europe, and that euro story is breaking down. Coming into 21, Tom, I heard 130. People looking for that euro move to the moon. The ECB not being able to do anything about it. That story's changed and changed quickly.
I know you've taken the real yield to 90 minutes tomorrow. You see it in the yield space. I know you'll mention that, John, but I think in the data check, you also got to mention the earnings persistency we're seeing.
Yes, Tom, but also a reality check as well from some of the cyclical parts of this market, from this economy. Did you hear what American Airlines had to say?
No, I missed
in the last 24 hours. More job cuts could be coming. The demand explosion or return of demand that they thought would happen in the summer, that's getting pushed back. And we talked about Mr. O'Leary over at Ryanair in Europe. I remember hearing from him 3 months ago on Bloomberg TV, Tom. And Mr. O'Leary of Ryanair was talking about the beaches being packed in the summer in Europe. Does anyone think the beaches will still be packed this summer in Europe? A lot of this is getting pushed away. So we've got this really interesting dynamic taking place at the moment, Tom.
Yeah.
We've got this vaccine progress, tremendous progress in parts of the Middle East, Israel, the UAE, in the United States, in the UK, and then far behind is Europe as well. So you've got to think about this. The sequencing of reopening, has that shifted, Tom? Has it changed? Do we allow consumers to re-engage with the domestic economy but keep travel shut down through the remainder of 2021? So if you put in on that cyclical trade, what changes? What's changed in the last couple of months?
I think it is a shift, and it's cross currents as well. You see it in Bank of England with their reduced GDP forecast just out seconds ago. I mean, it is a lot of cross currents.
Down to 5% for 2021 versus the forecast back in November of 7.25%. They're the forecast coming out of the Bank of England. On the Bank of England itself, unchanged on the asset purchase programme, unchanged on rates as well. Joining us now is Andrew Sliman, Morgan Stanley Investment Management Senior Portfolio Manager. Andrew, there's a difference between valuations growing and growing into your valuation. What are you expecting later this year?
Well, I think the big surprise here is just the magnitude of earnings beats by these big companies. And when you have the 1, 2, and 3 largest companies in the S&P beating, and you're seeing consensus for the year going up 7-8%, that means the PE that everyone thought was so elevated is not as elevated as expected. So my experience is, maybe the stocks were hot going into earnings season, but you don't want to sell stocks that have that magnitude when you have a beat, and that's a very bullish sign. I think that's why the market really hasn't taken any pullbacks this month yet. Because of these beats. It's a very powerful, you don't want to sell stocks when their fundamentals are delivering at that magnitude. So I think that's that falls into the ledger of one of the pluses for the market later into the year.
Andrew, are we forecasting out or extrapolating out later in the year, or are we really going through an exercise of 2022?
Yeah, I mean, that's a great point. My thesis is still that you got to be careful on companies that really benefited from shutdown, because their year-over-year comps are going to get tougher next year. And so I think that's my thesis is the market is going to do well until optimism about vaccines, COVID getting behind us builds. It's going to come at a time when earning year-over-year comps for a lot of these companies are going to be tougher in 2022. So I think the market's going to struggle at some point this year, but I think it's too early right now because the numbers are still coming through.
Andrew, when you say the market, are you talking about big tech?
Yeah, I mean, I think that's one of the areas, but it's not just big tech. I think there's a lot of areas of the market. I mean, look, what's interesting is, John mentioned the economic data is coming in very strong. And normally the returns of the market, when you get this strength of the data, starts to regress lower because the Fed gets involved and the Fed starts to, temper or taper. And I don't think they are right now. So that's something that we have to balance is the cyclical impulse is still there. And usually confidence starts to wane at this point, I'm not sure it will.
So I agree with you, Andrew, that the shift in the Fed's reaction function actually gets more powerful as this recovery really starts to take hold, because they've told us they won't do anything. They won't step in on the rate side of things as things pick up, Andrew.
This is supremely important. I don't think people are focused enough on this. The Fed has done, I like to say the anti-Volcker pivot, right? They are saying they're going to let the economy run hot. I think this is why a lot of these cyclical areas of the market, including the banks, have a lot longer runway here than what's normal when the Fed steps in and, takes the punch bowl away. They're not going to this time. So I think the cyclical trade will continue to work here.
And Andrew, what's so interesting here is I don't hear anybody saying all boats rising. Remember that phrase? John and Lisa are too young to remember it. But the idea, forget about all these shifts and rotations, that we just get all boats rising. Is that feasible?
Well, yeah, but, there's certain areas of the market that are not rising, like the defensive stocks, consumer staples, utilities. All those areas are not rising. So that's risk off. And so I'm not sure it's all boat rising, but yeah, I think it's a pretty good scenario. But I agree with you, Tom. I think later this year, when we start to focus on year-over-year comps for next year, that's when it's going to get tougher for the market.
Andrew, great to catch up. Andrew Slimman there of Morgan Stanley Investment Management. Right. Lisa, how does it feel to be too young? The burden of youth. Just the burden of youth.
The burden is real. Let me tell you.
How is it? So
on
many
my shoulders.
emails. Oh,
Tom,
my word.
It's so difficult.
Yeah, let me tell you, especially when you go ice skating and then don't
Coming
go
in
to
the
the
morning,
doctor.
just carrying that burden of youth.
You were so medicated yesterday, Lisa. For those of you on radio, the cast is larger than it was yesterday.
Yeah, that's right. It's amazing, the medication, what it does to my abilities to look at bonds. I will say, just following up on what you were talking about, John, with respect to the reaction function of the Federal Reserve. Thank you.
Good. Don't hurt yourself when you pivot.
It's almost like I do this for a living. I was looking at the gap between 30-year and 5-year Treasury yields, and this yield curve actually widened out to the most since 2016. And basically, there is a question in markets: how much of this is an expectation of the U.S. selling that much more debt? How much is this an expectation of inflation? And this is a huge issue. If you take a look at the chart over a longer period of time, you'll really see that trajectory accelerating up, John, and it raises a lot of questions.
I was going to talk about this later. I agree with you, and it's because the data has got better over the last week.
The burden of
Let's just be clear about that.
Tom.
Lisa mentioned the ISM a little bit earlier this morning, Tom. Let's just sit there just for a moment. The employment component in that was really decent. So we've had that. We've had the ADP. We'll get claims in about an hour and 20 minutes. And what have we seen the estimate do? You noticed it yesterday. Started to creep higher ahead of payrolls Friday.
50, 70,
basically
100.
doubled, Tom. Now it's 100K. Positive 100K. I don't think 100K is good. I don't think it's enough. I don't think it gets it done. Nobody believes that. But the trajectory, the change of direction is better, Tom.
10 seconds, and this is good that Lisa does this. Folks, the media does not spend enough time looking at two yields, a spread market versus a single point glory.
We will do 530s a little bit later.
530s.
I promise. 530s.
Michael Darda wants us to do the 10s, 30s.
Okay, we can do that too. From New York City for our audience worldwide, seen on Bloomberg TV, heard on Bloomberg Radio. From New York to Boston to DC and San Francisco, and on Sirius XM channel 119. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is vowing that he will not retreat on sending out $1,400 checks as part of a stimulus package. The president told House Democrats he is willing to tighten the eligibility for the payments. Republicans have suggested making the checks smaller and sending them to fewer people. House Republicans have voted to keep Wyoming Representative Liz Cheney in her leadership role. They turned back an effort to remove her for voting to impeach Donald Trump. Meanwhile, House Democrats are preparing to oust Georgia Representative Marjorie Taylor Greene from 2 committees for her incendiary statements. House Republican leader Kevin McCarthy said he would take no action to punish her. It's the latest sign that the Federal Reserve is not close to scaling back its massive bond purchases. Fed officials played down the economic impact of recent stock market volatility. Chicago Fed President Charles Evans says he doesn't see the market swings as a link to macroeconomic borrowing costs for businesses or households. And officials say the UK has now passed the peak of the latest wave of the coronavirus pandemic. The country's chief medical officer says there's a downward slope of cases, hospitalizations and deaths. Meanwhile, 10 million people in the UK have been vaccinated. That is about 15% of the population. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I think, we're in a good spot right now with monetary policy. And, they're talking in the government about more fiscal policy. We really probably need that support to get us through till we get the vaccines well distributed.
We're in a good place. Right on script there from Loretta Mester, Cleveland Fed president. That is the script of the Federal Reserve right now. Policy is in a good place. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Thursday morning as we count you down to an important initial jobless claims report a little bit later this morning. Futures up just. We had some weight to the S&P 500 by around about 1/10%. We advanced about 4 points in the bond market, unchanged on a 10-year, 1.1427%. As Lisa points out, 530s, the widest spread between those two, the steepest curve on that basis, going all the way back to 2016. Elsewhere in the FX market, we have a break of 120 on euro dollar. We've been looking for that. There it is, euro dollar, Tom, 119.90, coming in about 0.4%.
Some real dynamics here, and I should notice sterling railing off the Bank of England, comments there on negative rates and such. Right now in Washington, Kevin Cirilli, our chief Washington correspondent. Kevin, what's the gap between the liberals and the moderates of the majority Democratic Party?
They don't want to compromise. Yesterday I said, I'm coming back to work today to one of my sources, and I said, what's going on with the stimulus plan? And really the daylight amongst progressives and centrists right now is huge. And as a result of that, the Senate this week is likely going to pass what the House did the other day with regards to the $1.9 trillion stimulus. But it's anyone's guess, really, if this is going to be able to pass, not just with the Republicans and Democrats, but because of that daylight that you have between the far left and the middle.
Well, I would suggest, Kevin, that so many of us are unused to where we are with Democrat structure in Washington. What is the process that they go through? Do they compromise? Is somebody put in the timeout chair? Is Joe Manchin the head of it all? I mean, what's the process you expect to see?
Well, in terms of the $1,400 stimulus checks, I think you're already seeing a little bit of the Democrats' leverage in terms of they want to lower the number of American households that qualify for there to be $1,400 stimulus checks. That's something that the far left does not like. I spoke with one liberal who told me essentially that there are already rumblings that they're deeply disappointed in terms of how some of the more centrist members of President Biden's administrations have been willing to cave on that, and that could set up a lot of tension in the Democratic Party for the next couple of years.
Can you have speed if you need to compromise, Kevin?
No. There's the speed here and really any working timetable, Jonathan, for when this is likely going to be passed, especially if they want to go through the process that they're trying to get it through, is likely, if not at the end of this month, in early to mid-March.
Meanwhile, not only is there dissonance between the left, far left, and the Democratic Party and the more centrist members, but within the Republican Party, there's a showdown that's been going on over GOP Representative Marjorie Taylor Greene, and we have McCarthy coming out saying that she's extreme, trying to remove her from certain committees. We also have Mitch McConnell saying the same, trying to paint her as an outlier. How much support does she have with the rank and file Republicans?
None. When I talk to members about her specifically, if they are willing to engage on the conversation of it, they are saying privately right now they don't like what she has done for the Republican Party at all. She's really boxed herself in terms of where she can grow in terms of her support. That said, many of the Republicans that I've spoken with would prefer that the process in her district, the constituents who elected her, that they be the ones to decide if that's the representative that is best for their district.
I mean, Kevin, I know in your sabbatical you did a staycation at the Trump Hotel. There were a few rooms available. But other than that, Kevin, when you look at the new Washington, what's it feel like?
I read Matthew McConaughey's Green Lights. I finally finished the book. And here's some gossip, Tom. Here's some gossip. People in this town want to know if McConaughey is going to run for office. He's been making the rounds on all of these shows. And everyone's saying, is Matthew McConaughey going to run for office in Texas? I wonder what Ted Cruz thinks about that.
What kind of politician is the gentleman actor?
Well, I think it would be he makes a really fascinating pitch for how to talk to the suburbs. I'll give him that.
This show got too serious for too long, didn't it? 20 minutes in.
Did you guys miss me?
Yeah.
My buddy Carl in the control room forgot my name. Okay, Lisa's in a cast. Tom Brady's back in the Super Bowl. I mean, what's going on here?
These things go together.
Do you want to find a word on the Super Bowl, Kevin? Do you want to find a word on that?
Besides the Eagles aren't in it?
I never thought I'd say this. I'm rooting for Andy Reid again. You know, he used to be our coach, so.
Okay.
Okay, inform our audience which flavor he's on.
Who's Andy Reid?
You're asking me?
The Chiefs.
The Chiefs. That's Mahomes, right?
Mahomes, yeah, that's
the golden
that's
voice
right
of
now.
radio, Michael Barr. I just walked past Michael Barr earlier this morning and just said, Mahomes or Brady? And he just said Mahomes.
Yeah.
And that was it. Bottom line, Mahomes. I don't know.
You'll be on the right side of history.
Yeah, Kevin Sorelli, great to see you.
Good to see you, Kevin. Thank you.
Thank you.
Thank you. I don't think we gave him a hard time at all.
No, we didn't. I
think gone for a month.
You know.
The hard time you gave me. Kevin
Yeah,
goes
well,
away
he
for
was
a month,
gone
and we
for 6
promo his
weeks.
show.
You know, he
Sound
was
on
gone for
weekdays,
6
5
weeks.
p.m. Eastern.
Oh, really?
On Bloomberg Radio.
After the real yield.
That's true. Are you my lead-up, my warm-up act again this Friday?
I'm so
Are you doing that
warm-up
again? That went really well. I heard the ratings were a little bit better, so I appreciate that.
Well,
Will you come back again on Friday?
I talked to Weston yesterday. He said never again.
I don't blame him. Let's get to the price section this morning. Futures are up a little bit, up about 5 points on the S&P 500. We advanced about 0.1%. But I think the one story talking to a lot of you out there this morning, financial markets, cross-asset worldwide, the stories in the FX market. Some pronounced dollar strength. It's broad-based. It's through G10. But what gets your attention is euro-dollar. It is a clean break of 120 at 119.84. And Tom, you mentioned it a couple of days ago that already one of the big calls for 21 on February 4th, it's breaking down early on in the year. Now, I'm not saying this is going to be the move for the rest of the year, just some cracks in a consensus trade quite early on in 21.
Well, the blended, the Bloomberg Dollar Index, which has got a more EM feel and it looks differently than the larger DXY. But again, these are 4 standard deviation wrong moves from, in the case of DXY, from a huge -2 all the way up through the center tendency to a positive 2. These are wrong moves for the weak dollar crew.
Talking of foreign exchange, the Bank of England doing what you all seem to love and have learned to love over the last 6 months. They're still talking about negative rates.
Why?
Don't know. They will work on a tiered system in case rates get cut below zero, but they do not intend to send a signal that negative rates are coming. I think sterling gets it. Cable 136.46 unchanged on the session. Sterling's been stronger against the euro as well. I think sterling gets it because most people are looking at the rollout of vaccinations in the UK and saying, we don't think the UK or the Bank of England will need to do more.
Okay, well, to explain the culture here, because we would never get those headlines out of the American Central Bank. Why are they so verbose about this?
I think they're talking it up, Tom, because they find the idea of talking it up to be stimulative. I don't know if anyone actually believes that negative rates will work outside of the ECB or the S&B for that matter.
John, I just learned Banters of Williamsburg is closed today. We can't watch Chelsea Tots.
Oh, no.
At Banters.
We can do it on my phone.
You know.
What are you looking at during the show, Tom?
We'll do it on my phone.
I'm figuring out 3 o'clock this afternoon.
Not the show.
You can explain about negative rates.
Tom's hardly ever logged into the terminal.
That's
From
true.
New York, coming up, Neil Dutter of
do my
Renaissance Macro on this better economy.
Jim Snabe, thank you so much for joining us. What was the biggest thing you've learned about what a leader needs to be?
Well, it's really an emotional, or it's about being authentic, about believing in the path you're taking.
From New York City, things are looking better in the United States of America over the last couple of months, that's for sure. For our audience worldwide, live on Bloomberg TV and radio, here's the price action. Futures advancing just a little bit, up 0.1% on the S&P 500. A little bit of outperformance there on the NASDAQ, up by around about 1/3%. Steeper yield curve has been the story over the last couple of weeks. Let's get to it. Your bond market, 5s, 10s, 30s. Lisa mentioned this earlier. Your 5-year yield at around about 46 basis points. Your 30-year at 193. This is the steepest curve, the biggest spread between 5s and 30s, going all the way back to October 2015 now. And there's a reason why some of the banks, JP Morgan and elsewhere, are talking up the financials. The banks this week having a really big week in the equity market. Finish on this, the FX market. What a story we've had over the last 12 months. Do you remember people talking up Europe, the response to the vaccination rollout, COVID-19, how much better it would be in Europe, how much more efficient it would be in Europe? I was part of that conversation too. It's what people expected to happen in the summer of last year. It didn't. But one thing that went with that story was the idea that the dollar would underperform, that the global economy, that cycle would build, and it would be that classic trade, short the dollar. So many people were positioned for it, but here we are, a break of 120 on euro dollar, a clean break at 119.86. We come in 0.4%. A consensus trade is breaking down, and it's not just because of the vaccine rollout. The data in America is picking up, and picking up fast. We'll talk about that in just a moment. Let's get you some movers quickly. Here's Romain Bostic.
Yeah, John, when you talk about the biggest movers of the day here, Alibaba, of course, back in the news, getting a report out of Reuters saying that there's finally a little bit more consensus on what's going to happen with Ant Financial, potentially setting up the stage for Ant Group to actually go public. It might take a couple of years. Remember, Bloomberg had a report yesterday saying that Chinese regulators had finally come to some consensus as well. PayPal moving higher here in the morning. They reported earnings here, and they really just knocked it out of the park, adding more than 70 million active accounts last year, 16 million alone in the quarter. You're seeing a lot of the other fintech stocks rally here this morning, including Square. So keep an eye on that space. And Canada Goose out with earnings just here before the bell, 474 million in sales in the most recent quarter here. So they're selling a lot of coats here. I'm not exactly sure, how you divide that and what that comes out to. That's Canadian. You convert that over. They're doing well. Flip up the board here and take a look at an interesting story that's been going on in the chip space. We had Qualcomm earnings come out. The earnings themselves weren't all that spectacular, but they gave an update here on this idea of this chip shortage. Basically, we've heard from automakers saying that they haven't really been able to get their hands on enough chips to basically continue production at the levels that they want to continue it. Qualcomm's new CEO said, this is a much broader issue. This goes beyond automotives. This really applies to everything. And they said it's going to be a while before folks manage to work through this glut. Remember, GM yesterday said they were going to idle 3 plants in North America, including one in Kansas here in the U.S. because they didn't have that. And then Aptiv, which Aptiv, not here on the screen there, Aptiv, a software maker, also said that they're actually not going to be able to provide any guidance because they have no visibility right now on what the production schedules are going to be for the automotive sector. So something to keep an eye on here. Apple in the news as well. There was a report there out of CNBC saying that they finally have some plans here to partner with Kia on that Apple car that may come, or who knows, it may not come. 2024, I'm told.
Apple car.
Yeah.
Okay, Romain Bostic, thank you so much. John, I want to mention off of your data check there, JP Morgan up 35% off of the election of President Biden.
Yeah.
Just a remarkable moonshot.
And in the last week, Tom, we've had a nice pickup in the banks on Wall Street as well, on the S&P 500. I think largely off the back of the move we've seen on the yield curve too. Yeah. But some of the banks out there on the south side pushing the story that we're not pricing in this reopening enough in the United States yet, Tom. And the data so far, it's early. I know it's it's only January data into February. The data so far does show an improvement in the last couple of weeks, and that improvement's important.
And you've also got almost a gloom cover trade. I know Lisa's familiar with that, where there's been so much gloom out there. You wonder about the elasticity as people catch up. Who they catch up to is Neil Dutta, without question, one of the most optimistic, persistent believers in the American economic experiment. Neil Dutta with Renaissance Macro is with us. Neil, just simply, do we underestimate the resilience and recovery ability of the American economy?
Well, that's what the consensus has been doing fairly consistently since the second week of April, Tom. And I think they're still doing it. I mean, you know, if you look at your own Bloomberg News consensus of economists, the growth estimate for 2021 is around 5%. I think more folks are thinking that we're going to have a good year, and that's welcome. But I don't think enough have appropriately sort of priced in the right tail scenario. We're going to have a good year.
The persistency.
I think we're going to have a great year.
Right.
And I think that's what's important, and that's what the markets need to kind of get their collective heads around.
The persistency of 5%, and there's a great assumption that we noodle down to a potential GDP of 2, even under 2%. I get the sense, Neil, you disagree with that. What is your run rate of a post-pandemic American economy?
I mean, I think it's higher than 2. I mean, you know, we had a lot of, you know, productivity was starting to pick up. I mean, I think in many respects, I mean, the structural growth outlook for the U.S. is in some way cyclical. I mean, this idea of running an economy hot, utilizing as many resources as possible, making employers, essentially forcing employers via a tight labor market to kind of seek out additional efficiencies through their existing workforce. That was, I think, showing some promise pre-pandemic, and I think the Fed's going to try it again, Tom. And that's why, even in the face of stronger data, the Fed is unlikely to budge on their policy guidance. And I think that's obviously a bullish backdrop for equity markets, but I think more importantly, it's a bullish backdrop for the broader U.S. economy. You know, things like R&D spending are picking up.
Yeah.
Are you really going to be worried about secular stagnation in the U.S. at a time when our banking system is much better capitalized? You mentioned the outperformance in the banks. We're doing a lot of fiscal policy. And, I mean, the ingenuity is obvious. Did anyone think we were going to get a vaccine within a year? We did it. So I think that speaks to a lot of, you know, the underlying growth dynamics and what's possible in the U.S.
Neil, you have been right.
2%
You've been absolutely right about this with your bullish call of the U.S. economy. And the gloom crew has been wrong. Yes, Tom. And I often find myself empathizing with them, not because I want to feel gloomy, but because a lot of people, including myself, want to see around corners. Okay. And the question is, what corner are we going to be looking at? Neil, what you're looking at right now is the potential for perhaps not overheating, but running hot. At what point does that force the market's hand? Perhaps the Fed doesn't move, but the market moves ahead of the Fed. At what point does it become too hot for equities to keep rallying, given where rates are right now versus where they could be?
I mean, real rates are negative 1%, Lisa. I mean, give me a call when they're at 0. We can talk maybe then. I mean, you know, it seems. I still think the idea of interest rates breaking the back of the equity market is still a long ways away. And remember, I mean, the biggest risk to the U.S. fixed income market really is when Europe, frankly, is able to sort of reestablish its status, its growth status. And that hasn't happened, I mean, for a while. So I think the risk to U.S. Treasuries really builds when you have, you know, broad-based participation in the global economy, and you know, and when Europe kind of reestablishes its AAA status, and I don't think that that's really happened yet.
I think Neil needs to come on weekly just to provide Lisa some therapy and provide the bears out there. Just don't you think, Tom?
Therapy? Does this count as therapy?
Just some bear therapy.
I think we're just,
you know,
we're
Neil,
on the edge of fair and balanced.
Neil, does he want to play in gloom therapy?
Come on every week. I'm sure he does that with his clients on a daily basis anyway. Neil, just quickly, on the economy, you mentioned just a couple of times that you don't think the market is quite picking up on this year, or at least the economics community is not. When you sit around the table with the team at Renaissance Macro at the moment, where do you think the missed opportunity is as you see this economy snapping back, gearing up in the way that you expect?
Where do I think the opportunity is? Well, I think you know, for me, I think things that are tied to the reopening trade still have room to go. I mean, if you look at things like airlines, if you look at hotels. But again, I mean, I think it's interesting. You mentioned what are the two sectors that have been doing well since Election Day? Banks, energy. Who would have thought that with the sort of unified democratic government? Yep. It's one of these things where you have these sort of sell-side equity baskets, and they're just an entire waste of time. I mean, I have the defense sector in my Republican basket, and I have the banks in my Democrat, and I have the Republicans in my banks in the Republican basket. Obviously, it doesn't work because fundamental growth dynamics matter more. And what that's telling you basically is that growth is picking up. If you have stronger growth, you're going to need more energy. Hence, oil prices go up, and the Fed is like a carpenter hammering the front end of the yield curve, right? And at the same time, the growth dynamics are kind of pushing up the long end. That steepens the yield curve. That's good for banks. So, I think let's focus on the growth dynamics. Let's sort of keep kind of turn away from some of these sort of political arguments, and I think that'll lead you to much better investment outcomes.
Certainly over the last couple of months. Neil, great to catch up, sir, as always. Neil Dutter there of Renaissance Macro. Great example of that with the previous administration, Tom. Tesla. Was the previous administration a clean energy administration?
Well said. Well
Tesla
said.
to the moon. Not just me saying it. Lots of people have referenced it, Tom. It's just a great example of what Neil's talking about.
When we design this program, though, folks, it's really important on radio and TV you understand. That's what we live for. We make jokes about it, but the Dutter-Abramowitz nexus there, John, is just profound. I mean, it's really important to create that conversational tension so we can realize how gloomy Lisa really is.
Wait, hold on a sec. I need to break in here to talk about gloom, okay? There is a question about being overly effervescent about markets and basically embracing the bullish narrative and trying to be somewhat cognizant of the risks still out there and, frankly, of the two-track economy and the longer-term consequences. I don't think that's just gloom. What's
we're just listening. We're listening. We're taking it on board.
I think it's an important thing to represent, to basically see what the risks are out there.
Are you finished? Do you have anything more
I've got lots more to say, but I'll let it go for right now.
John, 3, 2, 1. We do the surveillance. 3, 2, 1.
Really?
Very good.
That was good, Lisa. Thank you. We appreciate that. Coming up on the program, Dr. Tammy Lundstrom, Trinity Health Chief Medical Officer. I'm looking forward to that. We'll see if Lisa pulls it together. Ahead of that, futures look all right. Up 5 on the S&P. We advance about 0.1%. New York just looking beautiful.
Yes.
Isn't it just? Alongside
Banters
Tom Keene.
in Brooklyn looks even better.
And Lisa Abramowitz. I'm Jonathan Ferro. You know what, Tom? You're the only person I've met in New York that's never made it to Brooklyn. Still.
I haven't made it below 59th Street, but that's a different story.
Honestly. You should take a hike in those boots he's wearing.
Really?
Exactly.
I'll walk with you.
Cross the bridge.
We'll get a picture together.
I'm taking the L train.
We'll get a picture together. No, not on the subway, Tom. We're going to walk this. We'll walk this.
Well, we are we?
We're going to walk this. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is drawing a line in the sand on his coronavirus stimulus proposal. He's told House Democrats he will not back off his plan to send $1,400 checks to millions of Americans. The president says he is open to tightening the eligibility for the payments. Republicans have suggested that the checks be smaller and that fewer people get them. This will be Janet Yellen's first public effort to address the turmoil involving GameStop shares and broker-dealer Robinhood. The Treasury Secretary meets today with financial regulators. One of those regulators, the SEC, has already said it's seeking to identify potential misconduct. It will also look at brokerages' decisions to halt buying. And Senator Amy Klobuchar is proposing a sweeping reform to antitrust laws. Her proposal would make it easier to stop mergers and acquisitions in court. Plus, it would target conduct by dominant companies that thwarts competition from rivals. Klobuchar is the incoming chairwoman of the Senate's Committee on Antitrust Law and Competition. McKinsey & Company has agreed to settle claims stemming from the opioid epidemic. Bloomberg's learned that the consulting firm will pay more than $550 million to end lawsuits by roughly 4 dozen states. The suits claim that McKinsey helped fuel the opioid crisis by providing marketing advice to drug makers. And more than 30% of U.S. property owners are considered equity rich. That means their property is worth twice as much as the underlying mortgage. And according to Atom Data Solutions, the count of equity rich properties equities rose to 17.8 million of the 59 million mortgaged homes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We're certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Need a starting material, all the material which is also produced globally. You know, the world is a global village, so to speak, and then certainly if you're missing certain parts and you can't get it out of a certain country because there are export restrictions or whatever, because they won't keep it for yourself, this is a bit where it certainly is a bit struggling.
It's a real worry for the medical community, for the healthcare community worldwide. Franz Werner Haas there, the CureVac CEO. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the equity market, quick snapshot for you. Doing nicely through much of this week so far. Slight pause yesterday. The S&P 500 up around about 0.1%, 0.16 percentage points into positive territory, up around about 6 or 7 points there. In the bond market, yields just about higher, 113, call it 114 on a US 10-year. That spread between 5s and 30s, the widest since the back end of 2015. It is a steeper curve, supportive of the banks so far this week. We'll try and touch on that a little bit more a little bit later. We keep hitting on this one. Euro dollar 119.90, coming down 0.4%. Some real dollar strength, just asserting itself a bit more in G10, Tom, this morning.
A little bit of a good tape here, and of course all of this coming up to claims here, which we'll have for you in about 35 minutes, and then on to a jobs report, which is shaping up nicely for tomorrow. As you know, we've talked to a lot of fancy people in vaccines, people making vaccines, people at the cutting edge of scientific research. We also take great pride at Bloomberg Surveillance that we're talking to people operationally in the trenches. One of those is Tammy Lundstrom with Trinity Health of Michigan, with some 90 hospitals nationwide, and the operational reality of doing the vaccine. We're thrilled that Dr. Lundstrom could join us this morning. Tammy, I want to start with the pure medicine. Do you have a confidence that we can correctly execute right now a 2-dose strategy?
I am definitely confident that we can do that, and within Trinity Health, we've been doing that. We've ramped up, and we're delivering over 90% of shots in arms every 7 days compared to the vaccine that we get delivered to us. So we have ramped up and we're ready to go.
I can't emphasize enough, folks, this is the cutting edge of what we're all talking about. Dr. Lundstrom, with that said, when do we see the migration down to younger and younger people?
Probably somewhere around the late April to May timeframe. It's very heartening that J&J is ready to submit their FDA EUA approval. We're very excited to have more in our armamentarium than the 2 vaccines that we have, and we're anxious to get more supplies so we can get people protected.
Dr. Lundstrom, the U.S. is doing a lot better than a lot of nations. Canada and the European continent come to mind in the forefront. Are they going quickly enough to get ahead of the new strain of COVID that has emerged in the United Kingdom, that has emerged in South Africa?
Well, I think we can always go faster, and I think we're all committed to trying to get shots in arms as quickly as possible. We can't forget, though, that we still have to mask, we still have to physical distance, we still have to wash our hands, avoid crowds. So it's really a bundle of activities that we really have to double down on while we're trying to get shots in arms quickly.
Talking about getting shots in arms, a lot of people are talking anecdotally about how the vaccine has to be defrosted. And then if all the people don't show up to their scheduled appointments who are eligible currently, they discard the remaining vaccine. How much are you seeing that, and what can we do to avoid some of this waste?
Well, we are actually not doing that. We're creating waiting lists so that we have people and places that we can get the vaccine to quickly within a few minutes after knowing that we have excess doses. And we're also looking at using those excess doses to vaccinate inpatients in the hospital as they're discharged so that we don't waste a single dose.
How much discretion do you have around making those decisions, Doctor?
It's very difficult right now because it's a state-by-state decision of what the prioritization lists are. So we're following state by state, and our waiting list keep in mind of who's on the priority list per state, and we are following those guidelines. So we are keeping our waiting lists ready to go, and as states open up to more populations, we expand the list.
Would you find it helpful to get that flexibility, to have that extra discretion yourself?
I think that we've been able to manage through the difficulties of various state regulations and requirements of who's going first, and then keep our lists accordingly. We care for about 1 to 1.5% of all patients in the U.S., so we've got a lot of patients eager to get the vaccine, so that is a very good news. but also heartbreaking because we can't get supply fast enough.
Well, that's the point I wanted to bring up, Tammy. If we have Washington legislation, and with the scale of Trinity, folks, 90+ hospitals, multi-billion-dollar revenue stream with all those expenses as well, you get a check for, say, $10 million from Washington. What's your greatest need at Trinity right now with money from the government?
I would say our greatest need right now is the vaccine supply, and then followed by staffing. We know that staffing is very precious, difficult. Colleagues are tired, so really getting some supplemental staffing to help us not only balance the 1,200 or more patients with COVID-19 that we have in our hospitals today, people that are coming to us for emergency care and heart attacks and strokes, but also getting the vaccine clinics up and running and partnering with public health in our communities to really try to get a collective mass vaccination sites and move to getting shots in arms as quickly as possible.
Doctor, thank you. And thank you so much on behalf of us all for the hard work you're doing at the moment. We appreciate it. Please come back soon. Dr. Tammy Lundstrom there of Trinity Health. Tom, some of the latest numbers for you. 35 million doses have been given in the United States. I think our average daily rate last week was 1.34 million. We need to try and keep up that pace, hopefully increase it, but that's going to come down to supply and whether we hit any roadblocks, some obstacles down the road.
We've come a long way in a month and a half, John, that 1 million or whatever per day. It just adds up. And as you heard, Dr. Lundstrom goes out to April where we really start to click into the American population.
When does the pressure start to build, Lisa? When does the pressure start to build on policymakers across this country to pare back some of these restrictions once you get the most at-risk in society vaccinated?
Well, you're already seeing a lot of people say that we can't go into another lockdown, and there's sort of this tension right now as those new strains come up.
Yeah.
And people say that they're going to spread in the U.S. Like wildfire, the way that they did in the United Kingdom. I also think it's interesting going back to what you were talking about, John, with travel, which is how quickly can we get travel back up and running with this dissonance with the U.S. so far ahead of, say, Canada?
Yeah, this tension, this dynamic, I think is really, really interesting. The vaccination programs in the United States, the UK, decent, but the sequencing to reopen these economies is shifting somewhat. Tom, it's interesting to me that the UK is making travel more restrictive, not less.
Yeah, well,
in the coming months.
Each country, that's a good point. Each country is different as well. I mean, you know, again, rolling it out. Right now, I would say the UK really impressive.
Up 7 on the S&P this morning. Good morning to all. We advanced 0.2%. Coming up shortly, Sebastian Page of T. Rowe Price, the head of Global Multi-Asset. From New York City, heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
Animals across the globe are dying by alarming rates. A report by World Wildlife Fund and the Zoological Society of London found that populations of mammals, birds, amphibians, reptiles, and fish fell by 68% in the last 50 years. In the tropical Americas, the rate was worse, with a 94% decline in the same period, and the size of observed wildlife populations in or near freshwater globally have fallen by 84%. Continued human abuse of the planet may lead to the collapse of the systems and resources that allow global civilization to persist in the first place. Overfishing and hunting, invasive species, pollution, habitat loss, and climate change are the main causes of this animal population crash. The report compiles evidence from 4,392 different vertebrate species and concludes the evidence for humanity's destruction of biodiversity is unequivocal. Using powerful computer models to simulate policy that stops biodiversity loss, scientists have explored scenarios to slow the trend. Such measures would include expanded conservation, increasing agricultural yields while also eliminating food waste, and cutting the global meat intake in half. By changing what the world eats and how it produces that food, nations could stop this tragic loss of life by almost 50%.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Friday is Jobs Day on Bloomberg Television. The first look at jobs in 2021 and what it means for a new U.S. relief package. The January Jobs Report, Friday at 8:30 on Bloomberg Surveillance.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Periods of excess credit, liquidity and boundless enthusiasm, there will be many bubbles forming in markets.
The system is, from a financial stability perspective, still is robust.
We haven't seen signals that these trades will spark any systemic risk.
The world doesn't shift just because you're buying shares online.
Markets are rewarding places with vaccination and normalization strategies.
There are a lot of people who can't go back to work.
The virus dictated the downturn, and it will dictate the pace and the shape of the recovery.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast Bloomberg Radio and Bloomberg Television across this nation and worldwide. And it is an optimistic tone to the markets. And, John, I'm not going to mince words. It's subtle, but this is a market that refuses to go down. In the last hour, we've had a nice, gentle lift up, again, a bid to stocks.
Equity market up by about 0.2% on the S&P 500, Tom, advancing 8 points. But it's been a decent week after a big week of losses last week, a snapback that's backed up, let's face it, by better earnings,
right.
1, the pandemic progress, 2, on the vaccination front, and better economic data, 3, ahead of payrolls tomorrow morning, and initial jobless claims, Tom, about 30 minutes away.
Well, we're going to see claims here, and that's after that good ADP report yesterday. And Lisa, within the gloom of the reality for a part of the American labor economy, we see non-farm payrolls go 50, 70, and now the survey's 100,000.
Yeah, and I think that the biggest actually data point from yesterday, John was mentioning this earlier, the ISM services numbers, the employment figures there that came in well better than expected, the highest levels, the biggest gain since February of last year. And it raises a question, Tom, of whether we're getting perhaps an acceleration, even in some of the hardest hit areas of the economy, even before we lift up some of the restrictions that we've seen from the COVID crisis.
To the two of you, John, let's start with you. What is your signal, John, from the bond market?
From the bond market right now, steeper curve, and I think that Neil Dutter absolutely nailed it. There's an elephant sitting on the front end of the curve. It's the Federal Reserve. That 2-year yield's going to do nothing. It's all going to be at the back end. That's all going to be driven by not by just supply, but by what supply will achieve. Higher growth, maybe better inflation numbers as well, and better economic data, full stop. And I think, Tom, over the last week, we're starting to see that just a little bit. Once again, underestimating the United States' ability in this economy to reopen and snap back faster. And we're seeing some evidence of that again.
And for those of you that slide into surveillance here at 8 o'clock, you've got to get up earlier so you can enjoy the Dutter-Abramowitz nexus we experienced in the last hour. Lisa, on the bond market.
Tom, I will just add on the credit side, you're seeing the same enthusiasm for the recovery trade.
Did you see Apple
idea, yeah, Apple is selling debt at nothing, right? I mean, they're able to sell 40-year bonds basically cheaply because why not? But there's a question of whether safety is actually the risk right now. The idea that investment-grade bonds that are considered safer have actually lost 1.6% so far this year, while junk bonds have gained nearly 1%, and you see inflows continuing into this debt. The idea that we have somehow foregone the default cycle and started anew, Tom.
One final question. Our guest is so important. I want to get to it. John, I'm looking at lesser, worse negative rates in Europe. I look at the Swiss 20 as a barometer, and it's done better. It is a lesser negative number. John, do you see a final relief to better negative numbers in Europe?
No, unfortunately not, Tom. Unfortunately not. I don't think the policy rate at the S&B, at the ECB is going anywhere anytime soon. We are so early in a recovery. Let's face it, Tom, hasn't even started. And I think there's some real doubts amongst the economics community as to whether you can even engineer a recovery in places like Europe that will lead to higher rates. Europe's looking a lot like Japan did 10, 20 years ago.
It is Bloomberg Surveillance on radio and television. You didn't know this, folks, but when we put together this show and all we've got coming for 2021, we were going to call it Nerd Police. But that got voted out. You know, it got voted out. And the reason is we've got to remember the basics of investing. We can do that with Sebastian Page of T. Rowe Price. Yeah, he's a geek and he does cross-asset, multi-asset and all that. But the reality is his book, Beyond Diversification, is absolutely critical. It's the #1 mistake people make with their investing portfolios, amateurs and pros every day. Sebastian, I'm honored to ask this question. What have you learned about Beyond Diversification when you look at GameStop and the madness of the last 6 weeks?
Well, you know, I've been thinking about your Dutta versus Abramowitz nexus. And I'd like to take a shot at reconciling that. I think as an industry right now, we're conflating two things, and they're hard to separate. But we're conflating the effects of liquidity with investor sentiment. And we're talking a lot about froth, and froth can lead to the failure of diversification when bubbles pop. But what is really creating the froth? We look at over 25 indicators of investor sentiment, and some of them don't show exuberance whatsoever. Cash holdings in equity mutual funds, top 10% of the last 10 years. Lots of cash being held in equity mutual funds. Equity fund flows are negative. People are pulling money out of equities. And if you look at individual investors, because we often blame, I think it's a mistake, but we often blame individual investors for froth in the markets. Well, the surveys of individual investors, when you ask them, are you bullish on the stock market for the next 6 months, or are you bearish on the stock market? The spread between the people who are bullish and the people who are bearish on the Lisa Abramowitz side, perhaps, I don't want to get into the debate here, but
carry on, Sebastian. This is good.
that spread is about 8%. So there's 8% more individual investors who are bullish over the next 6 months. It's not that high. It's actually close to historical data. Same for institutional investors. If you look at investor behavior indicators and you look at our institutional investors really positioned risk on in their portfolios. We're neutral between stocks and bonds, for example, and you get something that's closer to neutral. So why all the froth? And this is where we start conflating liquidity and investor sentiment. I don't know exactly, right? But we've had a 30% jump in M1 money supply, 25 trillion in global monetary and fiscal stimulus. You know, I would say that a lot of the froth and the localized bubbles are created just by this flood of liquidity, perhaps a bit more than investor exuberance per se. So this is me taking a shot at reconciling the nexus here.
With decent effort, you can come back and try again. That's the analysis. Let's get to the advice. Just a simple one, Sebastian. What do you do?
You know, right now, you would think stocks are expensive on an absolute basis for sure. And you talk a lot about this on your show, not necessarily on a relative basis, especially if you look at global stocks relative to bonds. We're asset allocators. We want to be invested for the long term. We end up neutral between stocks and bonds. However, our time horizon is 6 to 12 months to 18 months. And it's clear, and you were talking about vaccination a few minutes ago, it's clear that the destination for this year is COVID off. And the news on the vaccines have been really positive developments. It's a race against the mutations, but we're moving towards COVID off. So as an investor, ask yourself, what is the world going to look like in 12 months? And there is $1 trillion in excess personal disposable income. It's not equal, it's K-shaped, but there is pent-up demand in the economy for sure. So while we're positioning our portfolios neutral between stocks and bonds, we're taking advantage of relative valuation opportunities under the hood. We're long small caps. We're adding to credit. We're favoring bank loans over high yield. For the first time a couple months ago in about 10 years, we've tilted positive tactically towards value versus growth. We still think you need to hold both styles, but broadly speaking, Jonathan, it's neutral on a kind of broad risk on risk off basis. Yeah. Take advantage of the recovery trade under the hood. That's how we're positioned right now.
Sebastian, a lot there. I have to go to your attempt to resolve the nexus, the Dutta-Abrama nexus, which you did a great job talking about liquidity versus sentiment. But this dance is an uncomfortable dance, with liquidity driving market action and sentiment catching up. If sentiment catches up and people take that cash and they put it to work, whether it's in buying a trip, a plane ticket, or whether it's buying the next GameStop item, there is a question of whether that causes the liquidity to go away, right? This talks about the Fed dilemma. And at what point does liquidity drive markets more than sentiment? In other words, are we getting to a point where we could see sentiment being actually a bearish indicator if it turns too positive?
Absolutely. And, you know, the rate of change in liquidity has to go down. We just can't sustain 30% year over year jumps, and sentiment is improving. And if it improves too much without earnings sustaining market returns, you get in a very fragile situation. I think the key is to look at the usual, and this is an unprecedented environment. I promised myself I wouldn't say unprecedented because everyone says it, but it is. But the usual playbook for coming out of a recession, it's not at this stage in the recovery, it's not PE expansion. It's earnings recovery. And we're looking at plus 20% expected for 2021 on the S&P 500. So, Lisa, the way this fragility goes away is if earnings in 2021 deliver, if companies deliver on earnings, fundamentals increase. You could end up in a year where stock returns are maybe flat, maybe slightly down, but the average stock is up, because you get a broadening of the markets. Yep. Another way of describing the recovery trade, but that has to be sustained by earnings. Right now, financials look pretty strong, and you're talking about the steepening of the yield curve. Our analysts are upgrading financials, and tech is doing quite well. They continue to generate massive cash flows, accelerated digitization. So we can get out of it, but we need fundamentals to pick up over valuation.
What a happy diplomatic conversation. Sebastian, thank you. Come back soon. Sebastian Page, T. Rowe Price, Head of Multi-Asset Strategy. The market right now up 8 points on the S&P 500, advancing 0.2%. Tom Keene in about 19 minutes' time. Initial jobless claims in the United States of America. Claims, your estimate, 830,000. The previous read, 847. Tom, considering when we were 12 months ago, still in the wrong place.
That's the one statistic that sticks out. ADP good, and of course the tone on the jobs report. 1 month's data is actually pretty good, but you're right, John. Claims just has not broken in. Futures up 8, Dow futures up 26. John, there's a lift to the tape.
There is. A marginal one, up 0.2% of the S&P. Coming up on the program, Republican Congressman from Kentucky, Andy Barr from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is vowing that he will not retreat on sending out $1,400 checks as part of a stimulus package. The president told House Democrats he is willing to tighten the eligibility for the payments. Republicans have suggested making the checks smaller and sending them to fewer people. And this will be Janet Yellen's first public effort to address the turmoil involving GameStop shares and broker-dealer Robinhood. The Treasury Secretary meets today with financial regulators. Yellen spoke this morning to ABC News.
We need to understand deeply what happened before we go to action, but certainly we're looking carefully at these events. We really need to make sure that our financial markets are functioning properly, efficiently, and that investors are protected.
One of those regulators Yellen is meeting with, the SEC, has already said it's seeking to identify potential misconduct. And House Republicans have voted to keep Wyoming Representative Liz Cheney in her leadership role. They turned back an effort to remove her from...
I'm placing an order to sell, to stop and sell euro at 119.93.2. So stop on profit for 119.93.
This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
What I think a mistake would be is if we take this opportunity and it's used to foist more regulation on those that want greater access. I think that's directionally not the way of the world, not the way of the economy, not the way of technology. So I think we're going to have it's really an open question directionally what comes out of this hearing.
Congressman Patrick McHenry there, the House Financial Services Committee ranking member from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Counting you down to the opening bell, about 1 hour and 12 minutes away. Futures with a lift, the equity market pushing higher, up 9 points on the S&P. We advance a little more than 1/4%, or there and thereabouts, up 1/4%. In the FX market, euro dollar a break of 120 briefly. We're creeping back up to that level now at 119.96. And in the bond market, 114.27 is your yield, Tom Keene, on a US 10-year, 1.1427%.
An optimistic tilt, and again, a bit up through the morning here on equities. Right now, full disclosure, folks, long ago and far away, there was a set of repeated grandfathers that were called Henry Clay Keene. And if you go to Henry Clay High School in Lexington, Kentucky, you have an interior knowledge of the Whigs, their success, and their failure in the 19th century. Andy Barr joins us now. He is a member of the GOP, which is what you are in Kentucky, and joins us from the 6th Congressional District and from the capital of this nation. Andy, you more qualified than Mitch McConnell to talk about this trap of your GOP going the way of the Whigs. What do the Republicans do to not repeat Henry Clay's history?
Well, that's a great question, and obviously there is some soul searching. Anytime you lose a presidential election, a party should do that. We're doing that, and I think we've come to a good place as of last night with our meeting to make sure people understand the Republican Party is a big tent, diverse party. We have a small number of colleagues who voted to impeach the president, a large number of members who voted against impeaching the president, but we recognize that we need to attract a lot of people to the Republican Party because we're the party of free enterprise and limited government, and as you see from this president, it's a very different story.
We have a president preaching bipartisanship. Is your party too frugal? Are the Republicans too austere for 2022?
No, not at all. In fact, some would argue we're not fiscally responsible enough given the $4 trillion that we borrowed last year in response to the pandemic. But the truth of the matter is we have over $1 trillion in unspent stimulus funds left, and we're rushing to borrow another $2 trillion. That's why you're not seeing a lot of bipartisanship. Unfortunately, the president is not working with Republicans. They're using a budget procedure to ram through this $2 trillion in
Oh, come on. You guys used the same
without.
procedure. Stop it.
Well, we did.
You did the same
we
procedure
did.
last time around.
We certainly did, and there's nothing inherently wrong with using the procedure, but if you want to be bipartisan about it, you don't use that procedure, frankly. And this president has said that he wants to be bipartisan, but when he had the opportunity to do it, he's obviously turned away from that.
Congressman, we've got to get through a lot of topics, not just stimulus, but also on regulation. I understand you're on the House Subcommittee on Oversight and Investigations as well. Given the events in the last couple of weeks in financial markets, leading the administration is Secretary Yellen. Do you think she needs to recuse herself from this?
Well, I don't know if she needs to recuse herself, but what I want to see from Secretary Yellen is a little bit of caution and deliberation and not a lot of overreaction to this. The broader markets are doing just fine. Obviously, there was volatility with respect to Reddit-fueled trades on GameStop and other AMC and other equities, but that's actually as a result of the advent of zero-cost trading and the democratization of access to the capital markets. That's not a bad thing. And I think what you're seeing is the market's actually functioning fairly well with market discipline setting in, both with the hedge funds who are learning a lot about zero-cost trading and the influx of day trading and what that means for their short positions. It means that short squeezes are very possible. And I think there's market discipline that will set in with these hedge funds and professional Wall Street professionals. On the other hand, I think a lot of the day traders and the small investors are learning about capitalism, learning that fundamentals matter, learning that earnings and valuation matter, and that on the down.
Well, we closed position on euro, as you can see, just right here. So well done, guys. You placed an order, you made trade, and was successfully executed. So Well done. Let's see how long it took you to make profit. Around 10 to 12 we purchased, and a couple of hours. It all depends, yes, again, on your spread and how much broker pays you per pip. So in our case, we have £100 per pip, 2 pips, £100. Okay, well done.
I think there will be some questions about social media. There's questions about social media all the way around, both in terms of financial marketplaces, but also in the marketplace of ideas. And that's always appropriate for us to look at social media, the role of social media. But I think the more information generally, the better. People need to understand the sources of that information. But at the end of the day, I believe that democratization of access to capital, the advent of low-cost, no-cost trading platforms, and more information is a good thing. It's not illegal to share stock tips or ideas about the equity markets.
Congressman Barr, very quickly here, not enough time. I don't care about that. What I care about, are we going to endure with another running of the Kentucky Derby May 1st?
Yes, we will. In fact, I've talked to Churchill Downs. They're never going to do what they did last year and shut down the Derby on the first Saturday in May. And that's a good thing. As co-chairman of the Congressional Horse Caucus, we want the Derby to be back on the first Saturday in May.
There we go.
We hope it will be with spectators.
We'll see if we'll get the spectators.
As a foreigner, I'm not sure if that caucus even exists
The
or not.
Congressional Horse Committee? Is
Andy,
that
does
real?
that exist? Is that a thing?
No, look, you know, there's a lot of betting that goes on in Kentucky.
Really?
There's some
You don't
there's some speculative trading that we've seen. But you know what I love? I love that you know, a lot of the millennials are participating in the stock market now, and some people have said that millennials are more open to socialism. It looks like from this GameStop story that many millennials are more interested in capitalism. That is a good thing.
I just want to find out who's running the book down on Capitol Hill for the Republicans. Great to catch up, Andy. Let's continue this dialogue. Andy Barr there, Republican from Kentucky. Congressman, thank you. Tom King, futures up 8. We've got an important data point in about 5 minutes' time.
It's an important data point, and so important after that good ADP report leading on to tomorrow's jobs report. Again, a good survey there lifting up.
John, I just have to point out that indeed the Congressional Horse Caucus is an actual thing.
There you go.
Congressman Barr and Paul Tonko of New York.
Just 2 people in it.
Co-chairing. They're co-chairing the Congressional Horse Caucus.
Need to expand that a little bit more.
Are we going to take a bet on
remote the Monday after?
Yes.
Can you see Lisa
Yes.
there with a mint julep?
Yes.
With the hat
going?
Love that, Tom.
with your thigh-high boots, Tom.
There we go. Silence. Silence from Keane. Economic data up next from New York. This is Bloomberg. From New York City for our audience worldwide, this is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your economic data coming out imminently in the United States. Ahead of that, futures higher, up by 8 or 9 points on the S&P 500. We advanced 0.2%. With your economic data in America, here is Michael McKee. Hey, Mike.
Good morning, John. Well, everybody's keeping an eye, of course, on jobless claims. The feeling is that we are going to get a big drop in jobless claims, and we do. 779,000 drops below 800,000 for the first time in about 4 weeks. The forecast was for 830, so that's much better than people anticipated. However, the thing you have to keep in mind is that we are not out of the woods yet, and you and I will talk about this later on your show, I know. With the airline announcements, American Airlines, 13,000 job cuts coming, United Airlines, 14,000 job cuts coming if they don't pass additional stimulus. So we're not out of the woods, but this is a bit of good news going forward. That's a drop of 33,000 from the previous week's level, and so we'll keep an eye on how this is going. The other number out this morning, non-farm productivity, it was expected to fall. It falls more than expected, down 4.8%. The forecast was for a 3% gain as unit labor costs rose 6.8%. The productivity number is very hard to interpret these days because of layoffs and the incredible swings in GDP from which this comes. We saw the big drop in the third quarter and productivity went way up. And now we've come down in terms of GDP and productivity way down. So you just kind of have to dismiss that, look beyond it at the moment.
Yeah, Mike, the crystal ball out to look forward. We've seen the non-farm payrolls go from 50 to 70 to 100. You've seen that a zillion times going down and going up. But is there a new velocity to the pickup here?
No, I think what it is more people are starting to put their forecasts out and incorporating the latest data. We had the big ADP number yesterday that will affect people's thinking. But the other thing is this is January, and seasonal adjustment factors are usually very big in January because normally we hire a lot of temporary retail workers, plus the UPS and Amazon hiring a lot of delivery people to get through the holiday season, and they lay them all off in January. Now, this year we may not see them laid off because they weren't hired because of the COVID economy. And so the seasonal adjustment factors will tend to add to job growth. At least that's the bet among economists.
We could see the market reaction, Mike. 10-year yields higher to the highest levels now since March of last year, shooting up to 1.15%. Holy cow. Wow, it's a lot of yield considering the fact of where we are over in Europe.
If I'd said that to you 5 years ago or 10
it would be a strange conversation. We're seeing stocks near session highs, at session highs. Mike, how good is this report if you start digging under the hood? I know you've come on and you've talked about the fluctuations, the idea of how messy it is. Can you give us a sense of how much comfort people can take from this particular report that we are making ongoing progress?
Well, we are making ongoing progress, and that is good news. We could slip back. It gives an argument to Janet Yellen and to Joe Biden, but we are making progress. The thing you have to keep in mind is that still with 779,000 jobless claims, that's still above the highest point we got to during the great financial crisis, and we are now just about 1 year into the COVID crisis. So we're still seeing a labor market that's in a lot of trouble and needs a lot of help. We've dropped now to 17.8 million in terms of continuing claims, but a lot of people now on the the additional claims, over 3 million on that, and that expires in March. So there is an urgency in Washington to get something done to keep those people, keep their heads above water.
Mike, are you going to be here tomorrow? Are you on your way to Tampa to see Brady win?
I am going to be here tomorrow. I will watch Tom on TV. And
very good. Michael McKee, thank you so much there. And again, the jobs report tomorrow. I'm sorry, John. Look, are we on John Farrow, are we on a 2% watch on a 30-year bond?
Where are we now? Let's get the board up.
195.
Let's take a look.
You know, we're
Yields
there.
Are creeping high. Data's decent.
It's creeping high.
Data's better.
Decent.
I don't want to say in absolute terms the data is decent because right now it's not. Relatively speaking, it's better, and that's important, and that's what matters for markets. Yields up 2 basis points to 195. Tom, if we get a decent print tomorrow, I think you can continue that lift in the Treasury market. If we carry on vaccinating Americans at the pace we are right now, I think you can carry on getting that lift. At some point, though, we start to talk about how self-limiting a Treasury sell-off is. We have added a lot of debt to this economy. How can this economy function? How can it function with yields going much higher than where they are now, Tom? And that's an important question.
Dana Peterson with us now with the Conference Board. Of course, her tour of duty with Citigroup for a good length of time. One of the most interesting pedigrees in American economics of Wesleyan and then the Combine at University of Wisconsin at Madison as well. Dana, have you rejiggered your Excel spreadsheets? That's what you do at the Conference Board. Are you moving the numbers around now, or is it steady as it goes?
Well, we are looking at potential upgrades to our forecast for the second quarter, given the fact that there is still a very high likelihood that there will be some fiscal supports coming through. It's not clear how big it'll be. Certainly, the current administration is thinking about more targeted stimulus checks. And also you have the Republican Party coming out with a program that's, roughly $900 billion rather than 1.9. But we're still looking to see that there could be potentially be some strength in the second quarter of this year.
Dana, what is it about the nature of this shock that means the economy is changing direction so quickly at any given time? The recovery is really, really fast when we just start to pare things back a little bit. What's your read on that?
Well, I mean, a lot of it has to do with the progression of the virus and how many cases there are, and certainly how governments react to that and how consumers react to that. But we're very constructive on the fact that we do have this vaccine rollout. Certainly, there have been some estimates in terms of when there could be a widespread availability of vaccines and herd immunity that could potentially mean that we start seeing a pickup in activity late spring. Over the summer, people get out there, travel, go to the beaches, spend money, and consequently we have a very strong second half of the year. But again, it really depends upon the evolution of the virus, whether or not there are new strains that come online that cause renewed disruptions in economic activity.
Dana, based on the data that we've been getting and the speed of the recovery, do you think that there's going to be less economic scarring than people had expected, say, 3 months ago?
Well, I mean, certainly in January, some of the data are better than expected. Most people were looking for potentially even a negative GDP print in the first quarter. Maybe we won't get that. Our own view is maybe we'll see 2% growth. But certainly there is still a lot of scope for scarring in the labor market. We still have roughly 9 million people who are not working. Many people have left the labor market, especially older workers and women. And certainly the older workers who retire, they're not coming back. But certainly with women, we're very concerned that they will have difficulty coming back into the labor market. And certainly there are going to be certain industries that are never going to be the same, certainly because of the virus. And so that means jobs are attached to that. So there still could be scarring in the labor market, even if GDP growth looks better than expected.
Dana, do you expect that we can apply stimulus to the people that really need the stimulus?
Well, I don't work in the government, so hopefully there are mechanisms to make sure that, certainly people who have experienced unemployment and also losses in income will get those stimulus checks, and that people who are potentially upper income or in that, kind of K-shaped recovery, the upper part of the K-shaped recovery that have not experienced any interruptions and are actually doing well, don't necessarily need it, but that we make sure that we get it to the people who really do need it. How that's going to work, I don't know, but let's hope that can be achieved.
Well, just to build on what Tom was talking about, there's a composition of the stimulus. It's very much at the heart of a heated debate, the idea of the efficiency of a $1,400 check to Americans making below a certain income versus funding to state and local government, or the necessity for both. What is the most efficient use of funding? What is the greatest need right now, Dana?
Well, I think, the needs are pretty myriad. Certainly you have individuals who are in trouble because they've had bouts of unemployment and or they've lost income. You also have state and local governments who have shouldered, part of the burden of this in terms of testing, caring for people through the healthcare system, also loss of revenues as people have been unemployed, and also as some people have been moving out of city regions. So it seems like there's a lot of trouble all around. And, it's not really up to me to determine where the money goes, but certainly as an economist, wherever there's pain, there is potential for dollars to go and to help these economies, either household balance sheets or the coffers of state and local governments.
Dana, great to catch up. Good to see you, as always. Dana Peterson there of the conference board. Thank you. From New York this morning, some economic data to pour over just a little bit. 779 is your initial jobless claims read. Previous read
it's a better
was
number.
812, a better revision. It is better, Tom, and we should talk about the direction of travel. It improves. But look at how the bond market responds to this. If you can get the curve up, 2s, 10s, 30s, and just have a look at things. This is what the Fed wants to see. Your two-year yield will do nothing. It will do nothing. And this is about the reaction function of the Fed. Even if the economy improves, we're not hiking rates for the time being. So the two-year will be pinned. And it's what happens at the long end, Tom. That's going to be more instructive about this curve in the months to come.
You're not going to hear this in the press conferences around the world of central banking. But, John, to allude to your point, central banks love when the market takes care of their heavy lifting. And that's clearly what we're seeing right now.
The market understands the reaction function of the Fed, Lisa.
Yeah.
That's important.
Right now we're looking at the spread between 2- and 10-year Treasury yields, a key spread for financials, widening out further now at the most since 2017. So you are seeing that continue. The question is, at what point does it get too hot? Does the bond market get ahead of where the Fed would like to be, John?
You'll start to hear some noises from the Fed pretty quickly, I imagine. Your equity market up 0.2%, 38.30 on the S&P 500. I know a man that has a year-end target of 38.50. His name is Chris Harvey of Wells Fargo, and he joins me on Bloomberg TV in about
very nice
40 minutes
security.
time. Do you like
that's
that?
good.
That's
like
my
that.
promo. That's my promo.
John, what's your view on 4,000 SPX? I mean, it's a tangible number. It's a big figure.
We get in there. Tom, the valuations are there, right? The multiples expanded. It's about where the earnings growth comes from now. Where do the earnings surprises come from?
Yeah.
For that, you need to pare back the restrictions on this economy quickly.
John.
Going to come down to the pandemic. As Mike says, it sounds boring. Michael McKee always says it. That's what it's about.
Right. John, huge social response to what we did. And I mean, you didn't even wear boots in the snowstorm. You were getting carted around.
What did we get
so
the response
much.
to?
The big boots and all that. I just for you, John, today on radio,
What is
it's
that?
the Davos boots.
Oh,
I
yeah.
wore the Davos boots today just for Pharaoh.
Do you know what I did for you? I joined Clubhouse the other day.
Yeah. You joined Clubhouse.
I joined Clubhouse the other day.
Is Lisa going to join?
I've got no idea what to do with it.
Wow.
If you're on Clubhouse, at Pharaoh TV, tell me what on earth I'm meant to do on that.
How's the club?
I've got no idea.
Go to Francine on that. I think she's like
Fran
Clubhouse
will
expert.
definitely know more than me about these things. I agree with you.
Drinking tea over there.
From New York, this is Bloomberg. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Also available on Clubhouse. No idea what happens there. There you go.
Well done.
Tom and I will do an after-hours thing with a drink. Can we do that?
Tots and Chelsea on Clubhouse. It works.
Tom, that works. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is drawing a line in the sand on his coronavirus stimulus proposal. He's told House Democrats he will not back off on his plan to send $1,400 checks to millions of Americans. The president says he is open to tightening the eligibility for the payments. Republicans have suggested that the checks be smaller and that fewer people get them. McKinsey & Company has agreed to settle claims stemming from the opioid epidemic. Bloomberg's learned that the consulting firm will pay more than $550 million to end lawsuits by roughly 4 dozen states. The suits claim that McKinsey helped fuel the opioid crisis by providing marketing advice to drug makers. And shares of Qualcomm are lower. The world's largest smartphone chip maker warned that it's struggling to meet demand. It's another sign that the global semiconductor shortage is spreading. Remote work and studying has spurred demand for computers, and car buying has surged as people avoid public transport. All that has led auto and electronics makers to boost their chip buying. And more than 30% of U.S. property owners are considered equity rich, and that means that their property is worth twice as much as the underlying mortgage. According to Atom Data Solutions, the count of equity-rich properties rose to 17.8 million of the 59 million mortgaged homes. On the other hand, underwater homes, those worth less than the mortgage, are now over 10% in 6 states in the South and Midwest. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
James Nabbit, thank you so much for joining us. What was the biggest thing you've learned about what a leader needs to be?
Well, it's really an emotional, or it's about being authentic, about believing in the path you're taking.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Small businesses around the country, so many of them have closed. They're the lifeblood of their communities, and they really need help to make it to the other side and to continue offering the jobs that are so important to so many Americans.
Good morning, everyone. Bloomberg Surveillance. Secretary, I'm still getting used to Secretary Yellen there, not Chair Yellen. Speaking of the need at the state and local level, we take a snapshot right now into primaries and then on to a November election for the mayor of the city of New York. Bill Pepitone not only has a magical name within all of the heritage of this great city, that would be baseball, but far more his public service in law enforcement in New York. And he joins us this morning for comments here and also worldwide on the state of our politics in law enforcement. Bill Pepitone, you would be a change agent and mayor. What would be your first task?
First task is to bring back public safety to the streets of New York City. Without public safety, we have nothing. We have no business, we have no economy, we have no tourism, we have unsafe schools. We have a New York City like we have right now, completely in chaos with no direction. Public safety is the building block for everything New York City, and that's step number one.
How do you take your public safety message across the cultures and the politics of the boroughs of this city?
Through conversation, through face-to-face meetings with community leaders, legitimate community leaders who want what's best for their constituents and their community members, getting the police and the community together in a room and not leaving that room until there are real solutions. It's not about painting city streets or fancy slogans. It's about real dialogue, real discussion, and real answers.
So you're one of only 2 Republicans running for the New York City mayoral office. How much do you think that this helps you or hurts you, given the antipathy to the former president in the region?
Well, before the primaries roll around, I'm pretty sure we're going to see a few more candidates jump in. I don't know if it helps or hurts me. My message stays the same. It's about New Yorkers. It's about public safety. It's about rebuilding our economy. As far as the president and the way Republicans are viewed in New York City, that's up to me to get my message out. And my message is far different than most that are running on the Democratic side, who just want to continue the same policy. So it's really about, it's up to me. I have to get my message out and make it clear to everyone.
What's the message that you have in terms of how to regain some financial stability to the region, given the incredible hit and the incredible deficit?
First and foremost, we have to open up our businesses. Our small businesses have been decimated by the policies of the governor and the mayor. We have to open it up. We have to do it safely. There is a path to doing it safely. We have to open up our venues. We have to open up Broadway, our sporting events. We have to get the heartbeat of the city rolling, and we have to get the MTA back on track. We have to invest in our infrastructure. The more people we get coming into the city, the more the city will rebound quicker.
Bill Pepitone, I'm fascinated how a Republican message rebuilds across the boroughs of this great city. Obviously, there's a comfort. I'm going to pick on Staten Island, and you know better than me the map of the city. At the margin, how do you fight the battle to get a larger Republican vote? What do you need from elite Republicans to make that story work?
We need support from elite Republicans. We need support from the Republican Party here in New York. They need to step up. They need to stand behind their candidates. They have to make a clear and smart decision on who that candidate's going to be, that person has the right message. My campaign has the right message. I know I'm the right person for New York City right now. So the party really needs to get behind me, to get, as I said, get behind my message and make it clear to New York that this is the path we need to travel to bring everything back.
We have messaging of Republicans around this nation greatly divided, as we just heard from the gentleman from the 6th District of Kentucky, between what I'm going to call a collegially Trumpism and less Trumpism. How do you fold the last 4 years of the national Republican experiment into how you campaign in New York City?
Well, I think you have to look at some of the policies that the president put in place that were successful. And you show the people how those policies worked here in New York City and helped people here in New York City and how they can continue to help people in New York City. You have to get past a lot of the lies and the misinformation that was put out by certain media outlets. And again, that comes down to face-to-face conversation with people.
All right. So aside from, wait, are you blaming media outlets? You're saying that basically build on that. What are you saying with respect to that?
Well, I think a lot of media outlets have put out misinformation throughout the president's 4-year term, designed to divide. And I think that's trickled down to our governor and our mayor as well.
Okay.
Their policies were meant to divide, and that's why we're in the situation we're in.
Do you think that the Republican support of cities like New York has been sufficient to help the region get out of the hole that it's currently in?
No, we need more support. We need more support from both parties, but especially the Republican Party, to get the message out, to show everyone this is the pathway to rebuild our city. They really need to be stronger, more forceful, and more boisterous.
You pull one final question, Bill Pepitone. You pull off the upset of the decade. How do you work with Governor Cuomo?
Well, I sit down with the governor. We start with a clean slate. I'm going to be a very different mayor than Bill de Blasio. I'm going to stand up for city residents. And again, we're going to have a clean slate, work on the issues, and I'm going to make my point to the governor that without New York City, there is no New York State. So if the governor has any further political aspirations, he has to help me rebuild the city.
Bill Pepitone, thank you so much. Running as a Republican for the mayor race, and of course, many, many candidates there heating up for those of you nationwide not following the race as well. Lisa, a spirited conversation to say the least.
Yeah, well, there's a big debate here, and it's not just about New York City. It's also about the coastal cities in general, and how do you rebuild areas that have gotten decimated with the question of what is the office market going to be going forward? How do we keep the tax base in high-tax states at a time when places like Florida and Texas are luring a lot of businesses away? It comes at a key time.
We will see. Futures up 10. I'm going to say hi for the day, Lisa. I say it's a pretty good tape.
Yeah, and I think that it comes on the back of some real good economic data. The jobless claims coming in much less than expected, still astronomical relative to history, but it raises a question of whether we're getting enough speed, enough critical speed to get to the other side.
Everyone can agree with Bill Pepitone. I mean, Lisa, what you and I see in small businesses in the city is just appalling. There's no other way to put it.
There was a story, though, today, Tom, that you might find interesting, that Manhattan purchases of homes actually skyrocketed in the month of January at the fastest pace in a long time. You saw it actually nearly double where we were in last month, is according to Douglas Elliman and Samuel Miller. So some life coming. Yeah, low rates.
Low rates, price down, and the haves have the capital to do it. But that's not the small business that Mr. Pepitone was talking about. A real sport there. Let me do a data check right now to move us on here through this important day. Claims we just saw a better than good number with a nice revision as well. Futures up 10, Dow futures up 59. The VIX, this is really, really important. The VIX 2425 has come in with a vengeance in the last 18 hours. 22.58, I believe that's a new low for the day for the volatility index, showing the good feeling in the market. Abramowitz with her foot on the 2-year yield, it won't move. 10-year yield 1.15%. I'm on the 2% watch on the 30-year bond. We're not there yet. 1.94%. We note dollar strong. We note euro weaker. 119.86. Stay with us through the day on Bloomberg Radio, on Bloomberg Television. Good morning.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning, good morning. This It's the countdown to the open, and the countdown to the open starts right now. With 30 minutes to go, equity futures higher, positive by 9 points on the S&P. We advance 0.2%. Let's get straight to it. We begin with the big issue, a turning point in the pandemic as global vaccinations top confirmed cases.
It's really a battle between kind of vaccinations and permutations.
The market wants a steady hand on the wheel.
They focus more on vaccine news.
We're looking at Moderna, Pfizer, Johnson & Johnson.
Vaccines are coming on stream.
The virus numbers, they're peaking out. Hospitalizations are peaking out.
That should lead to a better economic backdrop.
That should boost both the economy and the markets.
The virus dictated the downturn.
Vaccinations are obviously key for markets.
We're still in the depths of a pandemic.
COVID's our biggest challenge.
The second half of this year part, I think, is really dependent on the vaccine.
The timing with the vaccine rollout.
500 million in new vaccines by June.
The vaccination schedule will ultimately prevail.
We're at a kind of a peak of pessimism around the vaccine.
Things are going to be getting better.
Let's bring in the Bloomberg team, Kelly Lyons and Abigail Doolittle. Kaylee, the vaccination story is picking up.
We're making progress, John. More inoculations given across the globe than there are confirmed COVID cases. That inoculation number now at 108 million. Here in the U.S., that number is 35 million. That is 9 million more than confirmed cases here. But the not so good news is the rate is still relatively slow. The vaccination rate here stateside only around 1.34 million per day. And if that continues, it would take 11 months to cover just 3/4 of the population with a 2-dose vaccine. And then widening it out to look globally, John, the percentage of the population vaccinated is still relatively small. I'm talking just about 1.4% at this point. Obviously, things are going better in some countries like the UK and Israel, but more slowly in others like Germany and the European Union, where supply has been a big constraint. We did get news last night that Oxford is going to begin a trial combining vaccines from AstraZeneca and Pfizer, see what kind of results doses of each could produce, and depending on that, could enable greater flexibility when it comes to supply. But of course, John, the story now isn't just getting out the original vaccines, but also potentially adapting them for new variants like the ones first found in the UK, South Africa, and Brazil. Companies are already working on this, working on potential booster shots to protect against the new strains. Those extra shots, of course, could be a moneymaker for the pharma industry, potentially bringing in as much as $23 billion, according to Morgan Stanley estimates. But the details of that still being worked out, and timing is still a question mark, John, especially the timing at which this pandemic is finally going to end.
Very true. Kaylee, thank you. Look, in isolation, the United States needs to do better. We can all agree that. But relative to what's happening in Europe right now, it's decent. Your average rate in the last week, 1.34 million doses per day. And Abigail, the market's coming around to this story just a little bit more as this week grows older.
They certainly are, John, and we're seeing that in spades in the bond market because, of course, this week a big piece of it has been the reflation trade, and on this we have inflation expectations increasing. So for the most part, we have the yield curve steepening, 2/10s this week at its highest level since 2017. Yesterday, the 5/30 curve yield, its steepest since 2016. So a piece of this, of course, is that reopening trade, the idea that folks are going to go back out there, plus the idea that some sort of stimulus will get done, whether it'll be $600 billion or $1.9 trillion or somewhere in between, that money likely to go out into the economy. And again, fueling those inflation expectations. What sector is really benefiting, John? Not surprisingly, the banks. On the week, we have the banks up in a big way. Take a look at the financials over the last 3 days, up 3%. And this, of course, in contrast to the week before when stocks had their worst week of the year. So some of the reflation bulls probably liking the action we have this week, John.
Abigail, thank you. Let's hit the banks through the show. JP Morgan, Stephen Alexopoulos in the last couple of days in a note saying the following, quote, he's very bullish. Many people are. The bond market's supportive of that, at least for this week. And those banks are doing really well this week, so far at least anyway. Nuveen's Tony Rodriguez identifying a growing number of market tailwinds. He writes the following. Risk assets are benefiting from steady global economic data, vaccine optimism, reduced political uncertainty, and prospects for additional fiscal support. Tony, I'm pleased to say, joins us now for more. Tony, is this a relative story for you or a global one? Is it the United States versus Europe or a global economy doing better?
Well, good morning, John, and good to be with you. And actually, I think it's both of the things you just identified, because Europe is clearly a laggard, both in terms of the vaccine response and what we think will be the economic outcome. But it is a story of global growth benefiting from vaccine optimism, for example, global stimulus, both from the monetary and the fiscal side. So we think the U.S. will certainly benefit from that front, but we also think that you'll see very, very strong benefit to the emerging markets. So as an example, a lot of people talk about dollar weakness coming into this year, our view would be that the dollar is going to remain fairly steady versus kind of G7 currencies as it benefits from stronger growth, modestly rising rates. But what's really driving that is the reflation story and the return to kind of risk appetite and risk taking amongst investors. And that will accrue to the benefit of the emerging markets. So the story is a reflation story, and it's going to benefit what we think are credit markets, emerging markets, kind of areas that really got hit during the pandemic in 2020 that will now, I think, benefit from that recovery that we're going to see throughout the course of the year. It'll be bumpy, but we think it'll also be steady throughout the year.
Tony, let's walk through treasuries and where it leaves things for you right now. Abby mentioned that table with the 2s, the 10s, the 30s on it, and that steeper curve, 530s out to levels we haven't seen since 2015, 2016. Your 10-year right now at 115, your 30-year at 194. Tony, at what point does a sell-off become self-limiting because of the amount of debt we've added to this economy in the last 12 months?
So that's a great question, and it matters about both the level and the pace. So I would say that the level is going to be fine at a 1.5, even a 1 3/4, as long as you don't get there too quickly. To the extent that that happens over the next 30, 60 days, I think that will really put a damper on growth. It'll hurt kind of the housing sector, consumer durable goods areas, and it'll hurt investor sentiment. I think if we see a gradual rise where you wake up at the end of the year and you're sitting between 1.5 and 1 3/4, I think that the equity market and the underlying fundamental economy will be fine with that. So a little bit is about the pace of that rise in rates. We think it'll be, while bumpy over the course of the year, it is not going to derail the recovery by virtue of spiking in a very short period of time.
As you say, though, Tony, there's a story for the market and a story for the economy, and often, sometimes, they're not the same thing. For the economy, the amount of debt, the higher debt load, does that just for you mean lower growth, lower trend growth over the next several years, Tony?
It absolutely does. And we think that, you know, you can get growth, but the best way to fundamentally get growth is through labor force growth and productivity growth. You can certainly juice growth by adding leverage, but there's a limit to that. And where we now sit at 100% of GDP in the U.S., the global economy at over 350% of global GDP, you're running into the limits of how much you can increase growth by adding leverage. So what that ends up becoming is a weight on growth. So you need to eventually kind of pare down that level of debt, either through growth exceeding the growth rate of the debt or by actually paying it down. And in either case, that limits the potential growth for the broader U.S. and global economy. And that is also one of the factors that leads us to think that while we will see a rise in rates, we're not going to see a rise in rates to numbers that some people might throw out, like a 2.5% 10-year or 3% 10-year. We don't see the possibility of getting to those levels over the next 3 to 5 years, given the difficulties of generating inflation and generating growth in a world of such high debt and a productivity environment that's clearly not as attractive as what we used to live in back in the 1990s, for example, and early 2000s.
So, Tony, to what degree does the analysis that you've just laid out for us shape your capital allocation decisions over the medium term?
Well, I think what it shows is that this world that we're living in, some people sometimes refer to us on the fixed income side as working in the no income business. It says that it is going to be difficult to find high levels of income as we move forward here over the next couple of years. So what you need to do is be able to basically widen the playing field, look a little more broadly at how you generate income in a portfolio. Part of that is going down in credit. And we feel that you should be comfortable doing that in this environment because we are in a global recovery that we think will be extended over a couple of years where income, net income grows, cash flow grows, debt levels are manageable for corporates. So extending out the credit spectrum a bit and also extending into asset classes that or sectors of the fixed income market that most traditional investors maybe didn't participate in the past. But moving out of the low yield, no yield kind of treasury and sovereign credit world into corporate credit, emerging markets, preferreds, kind of less kind of basic sectors of the asset-backed markets, so not just credit cards and autos, but looking at extended sectors in the securitized space. All those are areas where we think you'll be able to find reasonable levels of income over the course of the next year or two.
Tony, good to catch up, mate. Appreciate your time. Tony Rodriguez there of Nuveen. Your equity market this morning up 9 on the S&P. We advanced about 0.25%. Let's get back to Abby to get you some movers.
Well, John, we have that modest risk-on tone. Impressive, the S&P 500 right now on pace for its fourth up day in a row. Holding back stocks, though, Apple suppliers, Qualcomm and Qorvo are both down sharply. Both put up mediocre quarters. Qualcomm also, their outlook disappointing. Supply chain issues. And Qorvo had rallied in a big way into this quarter, price to perfection. They didn't put it up. The stock is down. Two of the other stocks, well, Cirrus Logic is actually flipping slightly higher, but some pressure there. Nonetheless, Apple is sharply higher. Looking past these issues within the supply chain, the stock up 1.8% for a stock that had been down last week on the year, now nicely higher. Apple bulls must like that. And let's check in on that reflation trade once again, John, because we do have the banks trading just a bit higher here in the pre-market. Very solid gains, up more than 0.5%. And to your point, trading higher as that yield curve steepens, John.
It has been a very solid week for those financials. More on the banks from Avi a little bit later this hour. Coming up, the airline industry delivering a warning sign for the labour market ahead of tomorrow's payrolls report. That conversation is up next with Michael McKee and Brad Sack of D.E. Shaw Global Economics. The economic data over the last week has been decent. The corporate guidance from the airline industry, anything but at the moment. From New York City this morning, good morning. Futures positive, up 9. We advance 0.25%. This is Bloomberg.
very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Right now, we're in the teeth of the pandemic. At the Fed, we're certainly using aggressively, and I think we should be, all our tools to fight through this. We're not out of the woods yet by a long shot.
Dallas Fed President Robert Kaplan weighing in on the cloudy picture emerging in the labour market. Jobless claims falling to the lowest level since the end of November, but the corporate guidance telling a different story, with American Airlines forecasting another 13,000 layoffs. The CEO writing in an email, quote, "We believed we'd be looking at a summer schedule where we would need the full strength of our team. Regrettably, that is no longer the case." Mike, the outlook for this year, despite the huge vaccine effort, it's not got better.
Yeah, it's getting a little weird out there. Obviously, we're starting to see the yield curve steepen. You were talking about that just a short time ago, and that has people worried about inflation coming up. Charlie Evans yesterday saying that we should look past it. Here's what he's talking about. The numbers in March, April, and May last year were negative. Those will fall out of the overall CPI calculations starting next month, and so inflation will rise, but they got to look through it. And one of the reasons they're going to do that is because we see so many layoffs still occurring. You look at jobless claims today, 779,000. That is a drop of almost 60,000 between revisions and last week. And that just shows you that at this point, we're still way ahead of where we were at the height of the great financial crisis. And that's backed up by what you're talking about with the airlines. 13,000 jobs lost or could be lost by American Airlines if the government doesn't renew the unemployment benefits that they've been giving the airlines. And you can see right there how dramatic that is. The airlines are the white line. They don't come back, whereas the rest of the payrolls do. And United Airlines just this week said 14,000 jobs. So the economy is still weak. The labor market is not completely healed yet. And the Fed is keeping an eye on that. And we showed you the forecast for tomorrow in terms of jobs. And that's going to circle back to where we were with inflation and with the yield curve. If we get a strong jobs report, which we might because of seasonal factors, maybe yields keep going up. And then the question for the Fed is, do we start to see a break on the economy at a time when we're still seeing people getting laid off?
I just wonder if the airline industry, Mike, for you is the lagging indicator here, just because of how this story is developing at the moment and the sequencing of the reopening that we might see. It could well be that international travel is the last thing to actually reopen, given the vaccine effort and the fight against these new strains as well.
Yeah, the international effort is going to be very, very difficult for the airlines to get back to, and the domestic travel is going to be very difficult. And this kind of sums up the whole virus. And you were quoting me earlier this morning saying the virus is in charge.
Yeah.
Until people feel safe to get on a plane and go somewhere and be safe when they are there, it's going to be hard for the airlines to come back. So they're looking at some months or maybe even years of pain continuing.
What are we looking for tomorrow? 100K?
100K, that's changed a little bit, gone up a little bit over the last couple of days with stronger ADP, but it's really the seasonals, the people who aren't going to be laid off, that normally get laid off, the retailers in January, and so that probably means a stronger report. Does the market digest that, or do they let it go because they know it's a seasonal impact?
That estimate's doubled over the last couple of days. Mike, great to catch up. ADP was decent. The ISM, the services read, was decent. The employment component of that, good as well. Let's hope for more of the same. D Shaw's Brian Stack joins us now. Brian, let's just start with what we're seeing in the economy and what you're expecting just in terms of the sequencing of reopening. How has the story shifted for you in the last couple of months, if at all?
Yeah, so what we're seeing, of course, is some near-term restraint from the virus. As you just said, the virus essentially is in control here. But that's going to give way to a meaningful rebound from Q2 and beyond for the year. So we're in the camp of expecting a very robust year for U.S. GDP growth on the whole. We just have to get through some of this near-term restraint that we're seeing.
Brian, I was excited to talk to you about the bond market, so let's just jump straight to it and start there. So many people doubted the Treasury market in the next downturn, the next shock we would get. What did we learn from the test of 10 months ago?
Yeah, so we recently put out a paper called Running Low. It's available on our webpage under the research tab. And it takes a look at that period precisely to look at the hedging properties of treasuries. Treasuries have historically been the most important safe haven asset, but there was lots of questions about that function and whether it could be sustained in an environment with lower yields. So we come to 2020 and it's a perfect test. It's a major downside shock and risk-off episode starting at a time when yields are relatively low. And what we argue is that treasuries perform very well. The Fed was able to push yields down enough that the hedging properties that were realized from treasuries